Learning objectives. After studying this module, students will be able to know the meaning of partnership and its features, understand the meaning of partnership deed and its importance, know the provisions of Indian Partnership Act for partnership accounting, understand the methods for preparing partnership capital accounts, explain the concept of distribution of profit amongst partners, learn the methods of calculating interest on capital in various situations, elaborate the methods to calculate interest on drawings, explain the methods to make adjustment in profit and loss appropriation account. Nature of partnership. What is partnership? When two or more people start a business and share profit and loss, they are called as partners, and the association between them is known as a partnership. The Partnership Act 1932 defines partnership as the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. The persons who are in the partnership with each other are individually called as partners, and jointly that partnership is called as firm. The name which they carry out the business is called as firm's name. Features of partnership. The essential features of a partnership firm are two or more persons. There should be at least two persons to start a partnership and having common goals. The maximum limit of members can be 10 in a banking firm, but for other businesses, the maximum limit is 20. Agreement. It is an agreement between the partners to share profit and losses of the business. This agreement can be written or oral. Business. There should be some business to carry on in a partnership firm. Only co-ownership of a property does not mean partnership. Mutual agency. Business can be carried out by one partner on behalf of others, or everyone can carry out the task. Each partner carrying on the business is the principal as well as the agent for all the other partners. Salient features of partnership. Sharing of profit. There should be an agreement between the partners to share profit and loss of the business. If people start up a firm for charity purposes, then that is not called a partnership. Liability of partners. Each partner is liable to the third party for the acts of the firm individually as well as jointly. The liability of the partners is unlimited, and to pay off firms' debts, their personal assets can also be used. What is a partnership deed? The partnership deed is an agreement between the partners in written or in oral. It contains the terms of the agreement. It contains all the details about the business objectives, the contribution of capital by each partner, profit and loss sharing ratio between the partners, and entitlement of partners to interest on capital and interest on loan. The deed should be properly drafted and prepared as per the provisions of the Stamp Act, and preferably registered with the Registrar of Firms. Provisions relevant for accounting. The important provisions that affect partnership accounts are as follows. Profit sharing ratio. If nothing is mentioned about profit and loss sharing in partnership deed, then it should be distributed equally amongst the partners. Interest on capital. No partner can claim any interest on capital invested in the business by him without the consent of all the partners. In case no interest rate mentioned in deed, then it will be paid at 6% per annum. Provision relevant for accounting. Interest on drawings. The interest will not be charged on the drawings by the partners unless mentioned in the deed. Interest on advances. If any partner has lent the money to the business other than capital invested, then the partner can get interest on the amount at the rate of 6% per annum. Remuneration of firm's work. The partner cannot charge any salary for the work done in business unless it is mentioned in the deed. Indian Partnership Act specifies that if any partner receives any profit for himself from any business transaction or by using any business property, then he is accountable to pay it to the firm. If any partner carries any business other than a partnership firm, but is of the same nature and competing with the firm, then he should pay all profits to the firm. Special aspects of partnership accounts. In the accounting term, we treat the partnership firm similar to the sole proprietorship business with the following exceptions: maintenance of partners' capital accounts, distribution of profit and loss amongst the partners, adjustment for the wrong appropriation of profits in the past, reconstitution of the partnership firm, dissolution of the partnership firm, maintenance of capital accounts of partners. All transactions that are related to the partners are recorded through their capital accounts. These transactions include amount invested as capital, profits, partners' salary, interest on capital, and interest on drawings, etc. There are two methods to maintain the capital accounts of the partners. Methods for maintaining capital accounts of partners. Fixed capital method. In this method, the capital of the partners remains fixed by the time more amount is invested or withdrawn as per the agreement. All transactions like interest on capital, interest on drawings, the share of profit or loss, etc., are recorded in the partner's current account. The capital accounts of the partner will always show a credit balance which will remain the same unless there is an addition or withdrawal of capital. The current account of the partner may show a debit or a credit balance. So under fixed capital method, two accounts are maintained for each partner, vis-a-vis capital account and current account. The partner's capital accounts shall always appear on the liabilities side in the balance sheet, whereas the current account is to be shown on the liabilities side if they have a credit balance and on the assets side if they have a debit balance. Fluctuating capital method. Under fluctuating capital method only, one account is maintained for each partner, which is capital account. All the entries related to interest on capital, drawings, salary, etc. are done directly in the capital account of the partner. That's why the balance of the capital account does not remain fixed and keeps on changing. If no instructions are given, then the capital account is to be prepared under this method. Difference between fixed and fluctuating capital method of accounting. The main points of difference between the fixed and the fluctuating methods of accounting are as follows. Number of accounts. Under fixed capital account method, two accounts are prepared for each partner capital and partner's current account, whereas in fluctuating method only, capital accounts are maintained. Adjustments. In fixed capital method, all adjustments of transactions like interest on capital, salary, interest on drawing, etc. are done in the current account, whereas in another method, all these transactions are done in the capital account. Fixed balance. In fixed capital account method, the balance of capital account remained unchanged unless there is an investment in capital or withdrawal from the capital, whereas in another method, the balance of capital account fluctuates time to time. Credit balance. The capital accounts in fixed capital method always shows a credit balance, whereas in fluctuating method, the capital account sometimes shows a debit balance. Distribution of profit amongst partners. The distribution of profit and losses amongst the partners is done as per the ratio decided through deed. If there is nothing mentioned, then the profit and losses will be distributed equally amongst all the partners. In a partnership firm, it is important to prepare a profit and loss appropriation account to calculate the final amount of profit and loss to be distributed amongst the partners in their profit-sharing ratio decided in deed. Profit and loss appropriation account. The purpose of the profit and loss appropriation account is to show how the profit and loss are distributed amongst the partners. Whatever transactions a firm required to do for interest on capital, salary, partners, commissions, interest on drawings, etc., are to be done through this account. The profit and loss appropriation accounts start with net profit or net loss, which is transferred to the profit and loss account. The journal entries done are: 1. Transfer of profit and loss account to profit and loss appropriation account. There are two conditions in that situation. A. If the profit and loss account shows a credit balance. B. If the profit and loss account shows a debit balance. 2. Interest on capital. A. If crediting interest on capital to partner's capital account. Please note that this will be done for individual accounts of the partners. B. For transferring interest on capital to profit and loss appropriation account. 3. Interest on drawings. A. For charging interest on drawings to partners' capital accounts. B. For transferring interest on drawings to profit and loss appropriation account. 4. Partner's salary. A. For crediting partner's salary to partner's capital account. B. For transferring partner's salary to profit and loss appropriation account. 5. Partner's commission. A. For crediting commission to partner's capital account. B. For transferring commission paid to partners to profit and loss appropriation account. 6. Share of profit and loss after appropriation. A. If profit. B. If loss. Calculation of interest on capital. No interest is allowed on partners' capital without the consent of all the partners. When it is mentioned in the partnership deed, then the interest on capital is credited to the partners on the rate on which all the partners are agreed and for the time the capital remained in the business in the accounting year. The interest on capital is provided in two situations: when the partners do not contribute equally but share the profits equally; when the partners contribute the same amount of capital but the rate of profit sharing is unequal amongst them. Let us take the help of a few examples to understand to calculate the interest on capital. For example, Rohit, Rashmi and Rajan entered into a partnership, bringing in rupees 3 lakh, rupees 2 lakh and rupees 1 lakh into the business. They decided to share profits and losses equally and agreed that interest on capital will be provided to the partners at the rate 10% per annum. There was no addition or withdrawal of capital by any partner during the year, so their interest on capital will be calculated as 30,000 for Rohit, 20,000 for Rashmi, 10,000 for Rajan. Take another example, where Reshma and Radha, who are partners in a firm, and the capital account balance is rupees 2 lakh and rupees 1,50,000 respectively, on April the 1st, 2005. Reshma added more capital of rupees 1 lakh on August the 1st, 2005, and Radha brought in the further capital of rupees 1,50,000 on October the 1st, 2005. Interest is to be allowed at 6% per annum on the capitals. The interest on capital will be calculated as interest on drawings. Sometimes no opening capital is given. In that situation, we first need to calculate the opening capital before calculating interest on capital on the basis of closing capital, after making all kinds of adjustments out of that. Interest on drawings. The partnership deed may contain the adjustment to be done for interest on the amount withdrawn by the partners out of the firm. If there is nothing mentioned in the deed, then no interest will be charged. If it is mentioned in the deed, then the interest is being charged on the agreed rate for the period for which the amount is outstanding with the partners in an accounting year. The calculation of interest on drawings in different situations. When the fixed amount is withdrawn every month. Suppose a fixed amount of money is withdrawn by the partners in each month. So for calculating the time period, we must take care when was the fixed amount was withdrawn. If the money is withdrawn on the first day of every month, interest on total amount will be calculated for 6 months and 15 days. If withdrawn at the end of every month, it will be calculated for 5 months and 15 days. And if withdrawn is done in the middle of the month, it will be calculated for 6 months. For example, Ankit withdrew rupees 10,000 per month from the firm for his personal use during the year ending March 31st, 2006. The calculation of average period and the interest on drawings in different situations would be as follows. Interest on drawings when a fixed amount is withdrawn quarterly. When a partner withdraws a fixed amount in each quarter, then interest will be calculated on the basis of time the amount is withdrawn. If it is withdrawn at the beginning of the quarter, then the interest will be calculated for a period of 7.5 months. If the amount is withdrawn at the end of the quarter, then the interest will be calculated for 4.5 months. Let us take an example of Satish and Tilak, who are partners in a firm, sharing profits and losses equally. During the financial year 2005-2006, Satish withdrew rupees 30,000 quarterly. If interest is to be charged on drawings at 8% per annum, the calculation of average period and interest on drawings will be as follows. When different amounts are withdrawn by the partners at different intervals. When in the organization, the partners withdraw different amounts at different time periods. In that condition, the interest on the drawing is calculated on the basis of product method. In the production method, each time money withdrawn is multiplied by the months for which it remained withdrawn during the financial year. The period is calculated from the date of the withdrawal to the last day of the accounting year. For example, Shehnaz withdrew the following amounts from her firm for personal use during the year ending March 31st, 2006. Calculate interest on drawings by product method if the rate of interest to be charged is 7%. When dates of withdrawal are not specified. When the total amount withdrawn by the partners is given, but the date of withdrawing amount is not specified, in that case, it is assumed that the amount is withdrawn evenly throughout the year. For example, Shalin withdrew rupees 60,000 from partnership firm during the year ending March 31st, 2006, and the rate of interest on drawings is 8% per annum. For calculation of interest, the period would be taken as 6 months, which is the average period assuming that the amount is withdrawn evenly in the middle of the month throughout the year. The amount of interest on drawing works out to rupees 2,400 as follows. Guarantee of profit to a partner. At times, a new partner is involved in the firm by giving him a guarantee of a minimum amount as a way of profit share in the firm. Such a guarantee of money can be given by the old partners in a certain ratio or can be given by an old partner with the consent of the other partners. The minimum guaranteed amount shall be paid to the new partner when his share of profit as per the profit sharing ratio is less than the guaranteed amount. When dates of withdrawal not specified and past adjustments. Let us understand guarantee of profit with an example. Madhu and Rakshita, who are partners in a firm, decide to admit Kanika into their firm, giving her the guarantee of a minimum of rupees 25,000 as a share in the firm's profits. The firm earned a profit of rupees 1,20,000 during the year, and the agreed profit sharing ratio between the partners is decided as 2:3:1. Let us understand how this would be distributed between them. Past adjustments. At times, after preparing the final accounts, there are many mistakes, omissions found in preparation of statements or recording of transactions. All these acts of omission and commission can be corrected by making adjustments. So instead of changing the old accounts entries, necessary adjustments can be made either through profit and loss adjustment account or directly in the capital accounts of the concerned partners. Let us understand this with an example. Ramiz and Zahir are equal partners. Their capitals as on April the 1st, 2006 were rupees 50,000 and rupees 1 lakh respectively. After the accounts for the financial year ending March 31st, 2007 have been prepared, it is discovered that interest at the rate of 6% per annum as provided in the partnership deed has not been credited to the partners' capital accounts before distribution of profit. Omission of entries and final accounts. In this case, the interest on capital not credited to the partner's capital accounts works out to be rupees 3,000, 6 by 100 into 50,000 for Ramiz, and rupees 6,000, 6 by 100 into 1 lakh for Zahir. If the interest on capital had been duly provided, the firm's profit would have reduced by rupees 9,000. By this omission, the whole amount of profit as per profit and loss account, without adjustment of rupees 9,000, has been distributed among the partners in their profit-sharing ratio, and the amounts of interest on capital have not been credited to their capital accounts. This error can be rectified in any of the following ways. Final accounts. The final accounts of a partnership firm are prepared as prepared for a sole trading business. The only difference is the distribution of profits amongst the partners. After preparing the trading and profit and loss account, the net profit or net loss is transferred to the profit and loss appropriation account. All adjustments are made through the profit and loss appropriation account, whether it's interest on capital, interest on loan, salary, commissions, etc. This is done to differentiate between the results of operations of the business and the distribution of the profit among the owners. Summary. Let us summarize what we have learned in this module. When two or more people start a business or set up and share profit and loss, they are called as partners. The association between partners is known as partnership. There should be at least two persons to start a partnership and having common goals. The partnership deed is an agreement between the partners, written or oral. It contains the terms of the agreement. If nothing is mentioned about profit and loss sharing in partnership deed, then it should be distributed equally amongst the partners. No partner can claim any interest on capital invested in the business by him without the consent of all the partners. In fixed capital method, the capital of the partners remains fixed by the time more amount is invested or withdrawn as per the agreement. Under fluctuating capital method only, one account is maintained for each partner, which is capital account. The purpose of profit and loss appropriation account is to show how the profit and loss is distributed amongst the partners. At times,
Learning objectives. After studying this module, students will be able to calculate the new profit-sharing ratio, understand the concept of goodwill, learn the ways to calculate goodwill, know the accounting treatment of goodwill, understand how to create revaluation account, know the adjustment of accumulated profits and losses, understand how to deal with change in profit-sharing ratio. Modes of reconstitution of a partnership firm. What is reconstitution of a partnership firm? As we know that partnership is an agreement between two or more people to share profit and loss of the firm, the business can be carried on by all or by one on behalf of all partners. Any change in the already made agreement results in the reconstitution of the firm. The result is the end of the existing agreement, and a new agreement comes into existence with the change in the relationship of the partners of the partnership firm and their composition. The reconstitution happens due to the following reasons, like admission of a partner, death of a partner, change in profit sharing ratio, a partner becomes insolvent, or retirement of a partner, etc. Modes of reconstitution of a firm. The reconstitution of the firm happens in many ways. Admission of a new partner. A new partner may be admitted in the firm when the firm needs finances or managerial support. According to the provisions of Partnership Act 1932, unless it is otherwise provided in the partnership deed, a new partner can be admitted only when the existing partners unanimously agree for it. For example, Rohit and Ronit are partners, sharing profits in the ratio of 3:2. On April 1, 2007, they admitted Anil as a new partner with 1/6 share in profits of the firm. With this change, now there are 3 partners of the firm and it stand reconstituted. Changes in the profit sharing ratio. Change in the profit sharing ratio among existing partners. At times, partners of a firm decide to change the profit sharing ratio between them. Let us understand with this example. Rajiv, Sanjeev, and Manish are partners in a firm sharing profits in the ratio of 3:2:1. With effect from April 1, 2007, they decide to share profits equally as Manish brings in additional capital. This results in a change in the existing agreement leading to reconstitution of the firm. Retirement of an existing partner. At times, any partner takes retirement from the business due to some or the other reason like bad health, old age, or lack of interest in the business. For example, Rajiv, Ravi, and Rishabh are partners in the firm sharing profits in the ratio of 2:2:1. On account of illness, Rajiv retired from the firm on March 31, 2007. This results in reconstitution of the firm now having only 2 partners. Death of a partner. Partnership may stand reconstituted due to the death of any of the partner provided the rest of the partners decides to continue with the business as usual. Say, A, B, and C are partners in a firm sharing profits in the ratio 3:2:1. A died on March 31, 2007. B and C decide to carry on the business sharing future profits equally. The continuity of business by B and C sharing future profits equally leads to reconstitution of the firm. Admission of a new partner. When a firm needs additional requirement of funds or managerial help or wants to expand the business, then a new partner may be admitted to the firm to increase its existing resources. According to the Partnership Act 1932, a new partner can be admitted into the firm only with the consent of all the existing partners, unless otherwise agreed upon. After the admission of a new partner, a new agreement is constituted. The new partner entered in the firm may have two rights in the business. 1. Right to share the assets of the firm. 2. Right to share the profits of the partnership firm. For accessing the right in assets or in profits, the partners are supposed to bring an agreed amount of capital in the form of cash or kind. In the case of an established firm that is earning more profits than the normal rate of return on its capital, the new partner is required to contribute some additional amount known as premium or goodwill. Following are the other important points which require attention at the time of admission of a new partner. 1. New profit sharing ratio. 2. Sacrificing ratio. 3. Valuation and adjustment of goodwill. 4. Revaluation of assets and reassessment of liabilities. 5. Distribution of accumulated profits, reserves. 6. Adjustment of partners' capitals. New profit sharing ratio. When new partner is admitted in the firm, then he gets his share of profit from the existing partners. In the other words, we can say that when a new partner is admitted into the firm, then the old partners have to sacrifice their share of profit to adjust new partner. But the share of the new partner is decided by the existing partners amongst themselves. If there is nothing specified as the share of the new partner, then it is assumed that he will get the share in their profit-sharing ratio. While admission of a new partner, the profit-sharing ratio between the old partners will change, keeping in mind their respective contribution to the profit-sharing ratio of the incoming partner. For example, Amit and Anil are partners sharing profits in the ratio of 3:2. They admitted Suneet as a new partner for 1/5 share in the future profits of the firm. Calculate new profit sharing ratio of Amit, Anil and Suneet. Sacrificing ratio. The ratio in which the old partners are ready to sacrifice their share of profit in favor of the incoming partner is called sacrificing ratio. The new partner is required to compensate the old partners for their loss of share in the super profits of the firm, for which he brings in an additional amount known as premium or goodwill. Goodwill. With the passage of time, an established business develops a good name, connections, and reputation in the market. All these things help the business to earn more profits in comparison to a newly established business. In accounting, when we convert such advantages in the monetary value, that is known as goodwill. It is that asset which cannot be seen. Definition of goodwill. Goodwill can be defined as the present value of a firm's expected excess earnings, or as the capitalized value that is attached to the differential profit capacity of a business. Any firm that earns normal profits or is incurring losses has no goodwill. Factors affecting value of goodwill. The main factors that affects the goodwill are as follows. Nature of business. A firm that manufactures high-value products or having a stable demand can earn more profits and therefore has more goodwill. Location. If the business is centrally located or is at a place having many customers, the goodwill tends to be high. Efficiency in management. A well-established concern enjoys the benefit of high productivity and cost efficiency. This leads to higher profits, high goodwill. Market situation. The monopoly condition or limited competition helps an organization to earn higher profits and higher goodwill. Special advantages. The firm that has special facilities like import licenses, long-term contracts for supply of materials, well-known collaborators, patents, trademarks, etc. enjoy higher value of goodwill. Need for valuation of goodwill. Generally, we need to do the valuation of goodwill at the time of selling the business. But in the partnership concerns, the need for valuation of goodwill arises due to following reasons. Change in the profit-sharing ratio amongst partners, retirement of a partner, admission of a new partner, death of a partner, amalgamation of partnership firm, dissolution of a firm involving sale of business. Methods of valuation of goodwill. As goodwill is an asset that cannot be seen, so it is difficult to calculate its exact value. There are various methods to calculate the goodwill. Average profits method, super profits method, capitalization method, average profits method. Average profits method is based on the assumption that a new business will not be able to earn any profits during the first few years of its operations. Hence, if a person purchases a running business, must pay a sum which is equal to the profits he is likely to receive for the first few years as goodwill. The goodwill, therefore, should be calculated by multiplying the past average profits by the number of years during which the anticipated profits are expected to accrue. For example, if the past average profits of a business works out at Rs 30,000 and it is expected that such profits are likely to continue for another 3 years, the value of goodwill will be 90,000 rupees. Rupees 30,000 multiplied by 3. Super profit method. We have assumed earlier that in the initial years, a business does not earn profits through operations. Hence, the person who purchases the existing business has to pay in the form of goodwill a sum equal to his total profits which he is likely to receive for the first few years. But it is observed that the buyer's real benefit does not lie in total profits. It is limited to such amounts of profits which are in excess of the normal profit on capital employed in the same business. The excess of actual return over the normal profits is termed as super profits. For example, an existing firm earns 20,000 rupees on the capital of 1,80,000 rupees and the normal rate of return is 10%. The normal profits will be calculated as 18,000 rupees. 1,80,000 multiplied by 10 upon 100. The super profits will be rupees 2,000. Rupees 20,000 minus 18,000. The goodwill under the super profit method is calculated by multiplying the super profits by certain number of years of purchase. If, in the above example, it is expected that the benefit of super profits is likely to be available for 5 years in future, the goodwill will be valued at capitalization methods. Using this method, goodwill can be calculated by 2 ways. By capitalizing average profits. By capitalizing super profits. Capitalization of average profits. Using this method, The value of goodwill is calculated by deducting the net assets in the business from the capitalized value of the average profits on the basis of normal rate of return. This involves the following steps. 1. Find the average profits based on the past few years' performance. 2. Capitalize the average profits on the basis of the normal rate of return like this. 3. Find out the net assets by deducting the outside liabilities from total assets. 4. Calculate the goodwill by deducting net assets from the capitalized average profits. Premium method. When a new partner gives his share of goodwill in cash, then we follow premium method. This amount is shared by partners in their sacrificing ratio. If this amount is paid to the old partners directly by new partner, then no entry is being done in the books of accounts. But when the amount is paid through partnership firm, then the following entries are being done. The alternative method is to credit this amount to the new partner's capital account and then adjust it in favor of the existing partners in their sacrificing ratio. If the partners decide to retain the amount of premium in the business itself, then there is no need to pass any additional entry. If they decide to withdraw their amounts fully or partially, the following additional entry will be passed. Revaluation method. Revaluation method of goodwill. This method of valuation of goodwill is used when the new partner does not bring his share of goodwill in cash. In such a condition, books of accounts are increased in the accounting books by crediting the old partners in the old profit-sharing ratio. When goodwill account is to be handled in the books of account, there may be two situations to handle. No goodwill appears in the books of account when a new partner enters the business. Goodwill is already there in the books of accounts. When no goodwill exists in the books of accounts. When there is no goodwill in the books of accounts at the time of admission of a new partner, then the goodwill account is created with its full amount of goodwill. The journal entry would be goodwill account debit to old partner's capital account when goodwill already exists in the books of accounts. There may be the case that the goodwill already exists in the books of accounts, then the adjustment for goodwill in the old partner's capital accounts will be done only for the difference between the agreed value of goodwill and the amount of goodwill already appearing in the books of accounts. There may be two conditions of journal entry. If the amount of goodwill is less than the agreed amount, goodwill account debit to old partner's capital account. If the amount of the goodwill is more than the agreed amount, old partner's capital account debit to goodwill account. Hidden goodwill. What is hidden goodwill? At times, the goodwill is not given at the time of admitting a new partner in the business. In such a situation, it is to be drawn from the arrangement of capital and profit-sharing ratio. Let us take an example. X and Y are two partners sharing profits equally with capitals of Rs 40,000 each. They admitted Z as a new partner for 1/3 share in the profit. Z brings in Rs 50,000 as his capital. Based on the amount brought in by Z and his share in profit, the total capital of the newly constituted firm works out to be 1,50,000 rupees. Rupees 50,000 multiplied by 3. But the total capital of the three partners comes out to be 40,000 plus 40,000 plus 50,000, which is equal to 1,30,000. The difference is because of the goodwill, that is 20,000. 1,50,000 minus 1,30,000, which will be shared by both X and Y equally. So, their capital account will be increased by 50,000 rupees each, and total capital of the firm would be 1,50,000. If the goodwill is not be raised, then the Z's account will be debited by 10,000 and X and Y's account will be credited by 5,000 each. So, the capital of the firm remains same, that is 40,000. Accumulated profits and losses. Adjustment for accumulated profits and losses. At times, a firm can have accumulated profits which are not transferred to capital accounts of the partners. These are usually in the form of general reserve, reserve fund, or profit and loss account balance. The new partner has no right on any share in such accumulated profits. These are divided among the existing partners by transferring it to their capital accounts in old profit sharing ratio. And if there are some accumulated losses in the form of a debit balance of profit and loss account appearing in the balance sheet of the firm, revaluation of assets and reassessment of liabilities. At the time of the admission of a new partner, it is required to calculate whether the current value of the assets is shown in the books of accounts. In case there is any discrepancy like understated or overstated assets, the assets should be revalued. In the same way, liabilities are also shown at their current value in the books of accounts. In case some assets or liabilities are unrecorded, then these are to be included in the books of accounts. Revaluation account is prepared by the firm for recording these transactions. The profit or loss on revaluation of each asset and liability is transferred to revaluation account, and finally its balance is transferred to the capital accounts of the old partners in their old profit sharing ratio. Accumulated profits and losses entries. Journal entries for the revaluation of assets and liabilities. For increase in the value of the asset. For decrease in the value of an assets. For appreciation in the amount of liability. For reduction in the amount of liability. For an unrecorded asset. For an unrecorded liability. For transfer of gain on revaluation if credit balance. For transferring loss on revaluation. Adjustment of capitals. At times of admitting a new partner, the existing partners agree that their capitals should also be adjusted in proportionate to their profit-sharing ratio. In such a situation, the capital of the old partners can be calculated on the basis of the capital of new partner. The capitals thus calculated should be compared with their old capitals after all adjustments have been made. After that, the partner whose capital is less will bring the remaining amount to cover the shortage, and the partner who has a surplus will withdraw the excess amount of capital. Change in profit sharing ratio. Change in profit sharing ratio amongst existing partners. Sometimes the existing partners of a firm decide to change their already decided profit sharing ratio without any admission or retirement of a partner. For some partners, the result of this is a gain of additional share in future profits of the firm, while a loss of a part of the same for other partners. For example, X, Y, and Z were partners in a firm sharing profits in the ratios of 8:5:3. It is felt that X will no more be able to actively participate in the affairs of the firm. Hence, with effect from April 1, 2007, they decided that in future they will share the profits in the ratio of 5:6:5. This results in X losing 3/16 multiply 8/16 minus 5/16 share in profits, while Y and Z gaining 1/16 multiply by 6/16 minus 5/16 and 2/16 multiply by 5/16 minus 3/16. In such a situation, first of all, the loss and gain in the value of goodwill will have to be adjusted. This is done by raising goodwill at its full value in the old profit sharing ratio and then writing it off in the new ratio. Alternatively, losing partners can be credited and gaining partners debited with amounts without goodwill account appearing in the books of accounts. Any change in the profit sharing ratio involve adjustments in revaluation of assets and liabilities. Transfer of accumulated profit and losses to partners' capital accounts in the existing profit sharing ratio and adjustment of partners' capitals as per the new profit sharing ratio. Summary. Let us summarize what we have learned in this module. Reconstitution happens in case of admission of a new partner, death of partner, or retirement of a partner. A new partner can be admitted into the firm only with the consent of all the existing partners, unless otherwise agreed upon. A new partner may have the following rights: right to share the assets of the firm, right to share the profits of the partnership firm. The ratio in which the old partners are ready to sacrifice their share of profit in favor of the incoming partner is called sacrificing ratio. When we convert such advantages like reputation, connections, and names in the monetary value, known as goodwill, it is unseen asset. Generally, we need to do the valuation of goodwill at the time of selling the business. Three methods of calculating goodwill are average profit method, super profit method, and capitalization method. Learning objectives. After studying this module, students will be able to understand the concept of new profit sharing ratio, learn to calculate the gaining ratio, understand the concept of gaining ratio, explain about hidden goodwill, know the accounting treatment of hidden goodwill and its calculation, understand how to do revaluation of assets and liabilities, know the adjustment of accumulated profits and losses, understand how to prepare loan account of a retiring partner, prepare balance sheet of a reconstituted firm, Retirement or death of a partner. We all know that retirement or death of a partner also leads to reconstitution of a partnership firm. When a partner retires or at the time of death of a partner, the old partnership deed comes to an end and new partnership deed come into existence. The accounting treatment is more or less same in case of death of a partner or in case of retirement of a partner. In both the cases, we need to calculate the sum due to the retiring partner and to the legal representatives in case of deceased partner. After adjusting the goodwill, revaluation of assets and liabilities, and transfer of accumulated profits and losses. Calculating amount due to retiring or deceased partner. The sum that is due with the retiring partner or with the legal representative of the deceased partner includes credit amount of his capital account, credit balance of his current account, his share of reserves, his share of goodwill, his share in profit of revaluation of assets and liabilities, his share of updated profit, interest on capital till the date of death or retirement, salary or commission due. The following deductions are also required to be done from his account. Debit balance of his current account, his share of goodwill which is to be written off, his share of losses, loss due to revaluation of assets and liabilities, his drawings up to date of retirement or death. New profit sharing ratio. The various accounting aspects are involved in the time of death and retirement of a partner. New profit sharing ratio. New profit sharing ratio is the ratio in which all the remaining partners will share the profit and losses with each other after the death or retirement of a partner. The new share includes their own share and the share they got from the deceased or retired partner. Let us take the two situations. A. Generally, the partners acquired the share of the retired partner in old profit sharing ratio only, and that's why the new profit sharing ratio is not necessary to calculate. B. The continuing partners may acquire the share in the profit of the retiring or deceased partner, not in their old ratio, but rather in a proportion other than that. So, in such cases, there is need to compute the new profit sharing ratio among them, and it will be equal to sum total of their respective old share and the share acquired from the retiring or deceased partner. The contributing partners may agree on a specified new profit sharing ratio. In that case, the ratio so specified will be the new profit sharing ratio. Gaining ratio. What is gaining ratio? The gaining ratio is the ratio in which the continuing partners acquire the share from the retired or deceased partner in their old profit sharing ratio. In this, the gaining ratio would be the same old profit sharing ratio and no need to calculate the gaining ratio. If the share in which they acquire the share of the retiring or deceased partner is specified, then there is no need to calculate the gaining ratio, as it will be the ratio in which they have acquired the share of profit from the retiring deceased partner. We need to calculate the gaining ratio when the new profit sharing ratio of the continuing partners is specified. And in such situation, the gaining ratio should be calculated by deducting the old share of each continuing partners from his new share. Treatment of goodwill. The retired partner or deceased partner is entitled to have his share of goodwill at the time of retirement or death. So, at the time or retirement or death of a partner, valuation of goodwill is to be done as per the agreement between the partners. Among the partners, the retiring or deceased partner compensated for his share of goodwill by the continuing partners in their gaining ratio. The accounting treatment for goodwill in such a situation depends upon whether or not goodwill already appears in the books of the firm. Treatment of goodwill. When goodwill does not appear in the books of accounts, there are 4 ways in which retiring partner can be given the necessary credit for his loss of his share of goodwill. A. When goodwill is raised at its full value. In this case, the capital account of all the partners, including deceased or retired partner, is credited as per old profit sharing ratio, and goodwill account is debited with its full value. The full value of goodwill will appear in the balance sheet of the reconstituted firm. B. Goodwill is raised at its full value and written off immediately. If goodwill is not being shown in the balance sheet of the reconstituted firm, then after raising the goodwill at its value, it is immediately written off by debiting the remaining partners in their new profit sharing ratio and crediting the goodwill account with its full value. C. Goodwill is raised to the extent of retired or deceased partner's share and written off immediately. In this case, goodwill account is raised only to the extent of retired or deceased partner's share by debiting goodwill account with the proportionate amount and crediting only to the retired or deceased partner's capital account. Then, the continuing partners' capital accounts are debited in their gaining ratio and goodwill account credited to write it off. D. No goodwill account is raised at all in the firm's books of accounts. If it is decided that the goodwill will not appear in the books of firms, then in that case the following journal entry is done. When goodwill to appear in the books of accounts. When goodwill already appearing in the books of accounts. In case the value of goodwill already appears in the books of accounts and is equal to the current value of the goodwill, then there is no need to make any kind of adjustments, as it is assumed that the goodwill is credited to the capital accounts of all the partners. But if the current value of the goodwill is different than the one appearing in the books of accounts, then an adjustment is being done for the difference value. In this, 2 kinds of situations we can face. 1. If the book value of goodwill is lower than the present value. In this situation, the goodwill is raised to its current value by debiting the goodwill account with the excess of the difference between the current value and book value and crediting the partner's capital account as per their old profit sharing ratio. 2. If the book value of the goodwill is greater than the present value. In this case, the excess of book value over the current value will be credited to goodwill account and debited the capital account of all partners as per the old profit sharing ratio. Hidden goodwill. In above situations, goodwill will be entered in the balance sheet at its full value. If the partners decide that it should be written off fully or partially, it can be done by debiting the remaining partners' capital accounts in the new profit sharing ratio and crediting goodwill account with the respective value. What is hidden goodwill? At times, the firm make settlement by paying the retired partner or deceased partner a lump sum amount. In that case, the amount paid to him and the amount which is due to him after making necessary adjustment in the accumulated profit and loss and revaluation of assets and liabilities account will be treated as his share of goodwill. This is also known as hidden goodwill. Adjustment for revaluation of assets and liabilities. At times, at the retirement or death of a partner, there may be some assets which are not shown in their current value. Also, there can be some liabilities that are shown on the value lesser than the obligation. Or at times, there may be some assets which are not recorded in the books of accounts. So, make all these adjustments we need to prepare a revaluation account to find out the net loss or gain on revaluation of assets and liabilities. The following journal entries are to be done for these adjustments. For increase in the value of assets. For decrease in the value of assets. Adjustment of revaluation of assets and liabilities. For increase in the amount of liabilities. For decrease in the amount of liabilities. For an unrecorded assets. For an unrecorded liability. For distribution of profit or loss on revaluation. Adjustment of accumulated profits and losses. At times, the balance sheet of the firm show accumulated profits as reserves and accumulated losses as debit balance of profit and loss account. The person who is retiring is entitled to have the share in accumulated profits and is also required to share the accumulated losses, if any. The journal entries for the same purpose shall be: disposal amount due to retiring partner. The partner who is retiring, his account is settled by giving lump sum amount or installments as decided mutually by the partners. Section 37 of the Indian Partnership Act 1932 states that the partner who is going can receive either interest at 6% per annum till the date of payment or such share of profits which has been earned with his or her money. So, the total due amount of the partner who is going is calculated by making all the adjustments. If the firm is not in a position to pay the amount, then the amount due is transferred to the loan account of the retiring partner and it is debited to his account when it is paid. Adjustment for partner's capital account 1. When a partner retires or in case of death of a partner, the rest of the partners may adjust their capital contributions in the profit-sharing ratio decided by them. In such condition, the amount which is in the capital accounts of the partners may be treated as the capital of the firm if specified. Then, to calculate the new capital of the partners, the total capital is divided amongst the new partners as per their new profit-sharing ratio. If there is any excess of capital or loss, then that will be worked out. The journal entries for the same would be: let us understand this by the following situations. A. When the capital of the new firm as decided by the partners is specified. Mohit, Neeraj and Sohan are partners in a firm sharing profits in the ratio of 2:1:1. Neeraj retires and Mohit and Sohan decided that the capital of the new firm will be fixed at rupees 1,20,000. The capital accounts of Mohit and Sohan show a credit balance of rupees 82,000 and rupees 41,000 respectively. After making all the adjustments, calculate the actual cash to be paid off or to be brought in by the continuing partners and pass the necessary journal entries. Adjustment for partner's capital account 2. When the total capital of the new firm is not specified. Asha, Deepa and Lata are partners in a firm sharing profits in the ratio of 3:2:1. Deepa retires. After making all adjustments relating to revaluation, goodwill and accumulated profit etc., the capital accounts of Asha and Lata showed a credit balance of rupees 1,60,000 and rupees 80,000 respectively. It was decided to adjust the capitals of Asha and Lata in their new profit sharing ratio. You are required to calculate the new capitals of the partners and record necessary journal entries for bringing in or withdrawal of the necessary amounts involved. When the amount payable to the retiring partner will be contributed by continuing partners in such a way that their capitals are adjusted proportionate to their new profit sharing ratio. Lalit, Pankaj and Rahul are partners sharing profits in the ratio of 4:3:3. After all adjustments on Lalit's retirement with respect to general reserve, goodwill and revaluation etc., the balances in their capital accounts stood at rupees 70,000, rupees 60,000 and rupees 50,000 respectively. It was decided that the amount payable to Lalit will be brought by Pankaj and Rahul in such a way as to make their capitals proportionate to their profit sharing ratio. Calculate the amount to be brought by Pankaj and Rahul and record necessary journal entries for the same. Also record necessary entry for payment to Lalit. After Lalit's retirement, the new profit sharing ratio between Pankaj and Rahul is 3:3, that is 1:1. Death of a partner 1. As we know that the accounting transactions will remain the same in the case of death of a partner as were in the retirement of a partner. In this case, the claim of the partner is given to his executors and will be settled as is being done in retiring of a partner. There is only one difference, is that the retirement has fixed time. It will be done at a specified time period only, whereas death can occur any time. There is no fixed time for this. So, in the case of death of a partner, his claim should include his share in profit and loss of the firm, interest on capital and drawings from the date of last balance sheet of the date of his death. Let us understand this with an example. Bakul, Champak and Darshan were partners in a firm sharing profits in the ratio of 5:4:1. The profit of the firm for the year ending on March 31, 2006 was 1 lakh rupees. Champak dies on June 30, 2006. Champak's share of profit for the period from April 1 to June 30, 2006 shall be calculated as follows. Death of a partner 2. If Champak's share of profit was to be calculated on the basis of average profits of the last 3 years, which were rupees 1,36,000 for 2003-2004, rupees 1,54,000 for 2004-2005, and rupees 1 lakh for 2005-2006. Champak's share of profits for the period from April 7, 2006 to June 30, 2006 shall be calculated on the basis of average profit based on profits for the last year calculation as follows. If the agreement provides that share of profit of the deceased partner will be worked out on the basis of sales, and it is specified that the sales during the year 2005-2006 were rupees 8 lakhs and the sales from April 1, 2006 to June 30, 2006 were rupees 1,50,000. Champak's share of profit for the period from April 1, 2006 to June 30, 2006 shall be calculated as follows. The journal entry of the same would be, let us take an example to understand this. Anil, Bhanu and Chandu were partners in a firm sharing profits in the ratio of 5:3:2. On March 31, 2007, their balance sheet was as under. Anil died on October 1, 2007. It was agreed between his executors and the remaining partners that A. Goodwill to be valued at 2.5 years purchase of the average profits of the previous 4 years, which were year 2003-2004, rupees 13,000, year 2004-2005, rupees 12,000, year 2005-2006, rupees 20,000, year 2006-2007, rupees 15,000. B. Patents be valued at rupees 8,000, machinery at rupees 28,000 and building at rupees 25,000. C. Profit for the year 2007-2008 to be taken as having accrued at the same rate as that of the previous year. D. Interest on capital be provided at 10% per annum. E. Half of the amount due to Anil be paid immediately. Prepare Anil's capital account and Anil's executor's account as on October 1, 2007. Summary. Let us summarize what we have learned in this module. New profit sharing ratio is the ratio in which all the remaining partners will share the profit and losses with each other after the death or retirement of a partner. The gaining ratio is the ratio in which the continuing partners acquire the share from the retired or deceased partner in their old profit sharing ratio. There are two ways to deal with goodwill. If it is already appearing in the books of accounts, or if the goodwill is not mentioned in the books of accounts. At times, the firm makes settlement by paying the retired partner or deceased partner a lump sum amount. In that case, the amount paid to him and the amount which is due to him after making necessary adjustment in the accumulated profit and loss and revaluation of assets and liabilities account will be treated as his share of goodwill. This is also known as hidden goodwill. Revaluation account helps to find out the net loss or gain on revaluation of assets and liabilities.
Learning objectives. After studying this module, Students will be able to understand the meaning of dissolution of a firm, explain different modes of dissolution of the firm, know the difference between dissolution of partnership and dissolution of firm, learn the rules for settlements amongst partners, learn how to prepare realization account, learn about the different journal and ledger entries. Meaning of dissolution of a firm. Definition of dissolution of a partnership firm. According to Section 39 of the Partnership Act 1932, the dissolution of the partnership between all the partners of a firm is called as the dissolution of a firm. This brings an end to the existence of the firm, and no business transactions are to be done after dissolution except the activities related to the closing of the firm, as all these need to be wound up by selling firm's assets and paying liabilities. Dissolution of partnership. There is a difference between the dissolution of the firm and dissolution of the partnership. The dissolution of partnership changes the relationship between the partners, which is already there, but the firm can continue its operations normally. The dissolution of the partnership may happen in the following ways: change in existing profit-sharing ratio among partners, admission of a new partner, retirement of a partner, death of a partner, insolvency of a partner, completion of the project, expiry of the period of partnership. Dissolution of firm. Dissolution of the partnership firm can happen without the involvement of the court or with the involvement of the court. When a firm dissolved, then the partnership between the partners also get dissolved. There are many ways in which the dissolution of the firm happens. Ways of dissolution of a partnership firm. The dissolution of a firm can happen in many ways. Let us discuss one by one the ways to dissolve a firm. Dissolution by agreement. A firm can be dissolved by the consent of all the partners or as per the contract between the partners. Compulsory dissolution. A firm dissolution is compulsory in the following cases. A. When all the partners or all but one partner become insolvent and become incompetent to sign the contract. B. When firm gets involved in the illegal business. C. When something happens due to which the business of the firm becomes unlawful. On the happenings of certain contingencies. As per the contract between the partners, a firm can be dissolved. A. If the firm is created for a fixed term, by the expiry of the term, the firm dissolves. B. If the firm is created to carry out one or more ventures, so when those ventures are completed, then the partnership also dissolves. C. Due to the death of the partner. D. By the formal judgment of a partner as an insolvent. Dissolution by notice. In case the partnership is on will, then if any one of the partner gives a notice in writing to another partners for the intention of dissolving the firm, then the firm gets dissolved. Difference between dissolution of partnership and dissolution of firm. Dissolution by court. A court may allow the partnership firm to be dissolved due to the following reasons. When a partner becomes permanently disabled to perform his duties well, when a partner becomes insane, when a partner misconduct and which can harm the business, when a partner breaks the partnership agreement, when the business of the firm cannot be carried on except at a loss. Difference between dissolution of the firm and dissolution of partnership. Termination of the business. In dissolution of the partnership, the business of the firm is not terminated, whereas in dissolution of the firm, the business is closed. Settlement of assets and liabilities. In dissolution of partnership, the assets and liabilities are revalued and new balance sheet is prepared, whereas in dissolution of the firm, assets are sold and liabilities are paid off. Court's intervention. In dissolution of partnership, the court's involvement is not required as it is dissolved on the mutual consent between the partners, whereas in dissolution of the firm, the court may intervene. Economic relationship. In dissolution of the partnership, the economic relationship between the partners is continued, whereas in dissolution of the firm, the economic relationship of the partners ends. Closure of books. Closure of books is not required in dissolution of the partnership as business is not closed, whereas closure of books is required to be done in case of dissolution of the firm. Other dissolution. The dissolution of the partnership may or may not involve the dissolution of the firm, whereas the dissolution of the business means end of partnership. Settlement of accounts 1. In case of dissolution of the firm need to close its business. So all the assets of the firm need to be disposed of and all the liabilities of the firm to be paid off, subject to agreement amongst the partners. The following rules as provided in Section 48 of the Partnership Act 1932 shall apply. A. Treatment of losses. Any loss arises in the firm including deficiencies of the capital need to be paid. A. First out of profits. B. Next out of capital of the partners. C. By the partners individually out of their profit-sharing ratio. B. Application of assets. The assets of the firm, including the sum contributed by the partners to make up deficiencies of capital, shall be applied in the following manner and order: in paying the debts of the firm to the third parties, in paying each partner proportionately what is due to him or her from the firm for advances, in paying to each partner proportionately what is due to him on account of capital. The residue should be divided among the partners in their profit-sharing ratio. So the amount realized from assets along with contribution from partners needs to be used first for paying off the liabilities that are outside the firm. For the paying off loans, creditors, the balance should be used to pay off advances made by the partners to the firm, and if any surplus is there, that amount should be used for settlements of the capital account balances. Settlement of accounts 2. Private debts and firm debts. The following rules as mentioned in Section 49 will be applicable when the debts of the firm and private debt of a partner coexist. First, the payment of debts of the firm is to be done out of property of the firm. Then, if any surplus is left, then it will be divided among all partners as per their claim that can be used for payment of their private liabilities. The private debts will be settled first out of the private property of any partner, and if any surplus is left, that will be utilized for payment of firm's debts in case the firm's liabilities are more than the firm's assets. It is to be noted that the private property of the partner does not include the personal property of his wife and children. So, if the assets of the firm are not sufficient to pay off firm's liabilities, the partners have to contribute out of their net private assets, which is private assets, private liabilities. Accounting treatment. When the firm is dissolved, then all the books related to accounts needs to be closed and profit and loss of after realization of assets and clearing of liabilities needs to be calculated. We have learned earlier also that a realization account is to be prepared to find out net profit or loss after realization of assets and clearing liabilities, which is to be shared by the partners in their profit-sharing ratio. Journal entries in case of dissolution of firm 1. Journal entries. We need to do the following journal entries in case of dissolution of the firm. For transfer of assets, all asset accounts excluding cash, bank and the fictitious assets need to be closed by transfer to the debit side of realization account at the book value. Sundry debtors is transferred at gross value and the provision for doubtful debts is transferred to the credit side of realization account with liabilities. The same thing will apply to fixed assets if provision for depreciation account is maintained. For transfer of liabilities, all the accounts related to external liabilities, including provisions, if any, are closed by transferring them to the credit of realization account. For sale of assets, the journal entry for the sale of assets would be for an asset taken over by a partner. When any asset is taken over by the partner, entry would be for payment of liabilities, the entry will be for a liability which a partner takes responsibility to discharge. If a partner takes up the responsibility to discharge a liability, then the entry will be for settlement with the creditor through transfer of assets. When a creditor accepts an asset in full and final settlement of his account, journal entry needs to be recorded. Journal entries in case of dissolution of firm 2. When a creditor accepts an asset whose value is more than the amount due to him, he or she will pay cash to the firm for the difference for which the entry will be. For payment of realization expenses, when the expenses are incurred and paid by the firm in the realization of assets and payment of liabilities, the entry will be when realization expenses are paid by the partner on behalf of the firm, then the entry will be when a partner is ready to undertake the dissolution work for a decided remuneration, bear the realization expenses. If the payment of realization expenses is made by the firm, then the entry will be if partner himself bears the realization expenses, then no entry is required to be done in books of accounts. For decided remuneration to that partner, the entry will be for realization of any unrecorded assets like goodwill. The entry will be for settlement of any liability which is not recorded in the books of accounts. For transfer of profit or loss on realization. In case of profit, the entry will be. In case of loss, the entry will be for transfer of accumulated profits in the form of reserve fund or general reserve. Journal entries in case of dissolution of firm 3. For transfer of fictitious assets, if any, to partners' capital accounts in their profit-sharing ratio. For payment of loans due to partners, the entry would be done as follows. For settlement of partners' accounts, when we have to settle partners' accounts, then the entry would be the balance is paid to partners whose capital accounts show a credit balance and the following entry is recorded. Let us understand this with an example. Sita, Rita and Meeta are partners sharing profit and losses in ratio of 2:2:1. Their balance sheet as on March 31st, 2007 is as follows. They decide to dissolve the business. The following amounts were realized. Plant and machinery 4,250 rupees. Stock 3,500 rupees and debtors 750 rupees. Sita agreed to bear all realization expenses. For the service, Sita is paid 60 rupees Actual expenses on realization amounted to 450 rupees. Creditors paid 2% less. There was an unrecorded asset of 250 rupees, which was taken over by Rita at 200 rupees. Prepare the necessary accounts to close the books of the firm. Summary. Let us summarize what we have learned in this module. The dissolution of the partnership between all the partners of a firm is called as the dissolution of a firm. Dissolution of the partnership firm can happen without the involvement of the court or with the involvement of the court. A firm can be dissolved by the consent of all the partners or as per the contract between the partners. Dissolution happens when all the partners or all but one partner become insolvent and become incompetent to sign the contract. If the firm is created for a fixed term, by the expiry of the term, the firm dissolves. A court may allow the partnership firm to be dissolved due to many reasons. In dissolution of the partnership, the business of the firm is not terminated, whereas in dissolution of the firm, the business is terminated. In dissolution of the partnership, the court's involvement is not required as it is dissolved on the mutual consent between the partners, whereas in dissolution of the firm, the court may intervene. In
Learning objectives. After studying this module, students will be able to understand the basic nature of a joint stock company, know the types of shares issued by a company, know the different accounting treatments for shares issued at par, premium or discount, define subscribed capital, understand the concept of forfeiture of shares, learn the concept of reissue of forfeited shares, learn how to prepare share forfeited account. Features of a company. 1. What is a company? As per Companies Act 1956, a company incorporated or registered under Companies Act or any other earlier Companies Act. As per Chief Justice Marshall, a company is a person, artificial, invisible, intangible, and existing only in the eyes of law. Being a mere creation of law, it possesses only those properties which the charter of its creation confers upon it, either expressly or as incidental to its very existence. Features of a company. The features of the company that makes it different from other organizations are as follows. Voluntary association. Those who want to form a company can come together voluntarily to carry on the business. That is why it is called voluntary organization. Separate legal entity. A company's legal entity is different from its members. A company can hold and deal with any kind of property. A company can do contracts and even open a bank account in its own name. It can sue others and can be sued by others. Limited liability. The members of the company is liable for the unpaid amount of the shares held by them. If the company is limited by guarantee, the liability of the members is limited to the guarantee given by them when the company is being wound up. Features of a company. 2. Perpetual succession. The company continues to exist even if there is a change in the membership, as we know that a company is an artificial person created by law. The death or insanity or insolvency of any member of the company in no way affects the existence of the company. Members may come and go, but the company continues. Common seal. As we know that a company is an artificial person and cannot sign its name by itself, so we need to have a seal that acts as official signatures of the company. The document that does not contain the seal of the company is considered to be illegal. Transfer of shares. The shares of a company which is public limited can be transferred easily. We do not require any permission from the company or permission of any member of the company to transfer shares. But the articles of the company can tell the manner in which the transfer of shares will be made, may sue or be sued. A company can enter into contracts and can take legal rights against the others in case of any breach of contract. It can be sued or can sue by its name. Kinds of a company. There are two ways to classify a company. A. On the basis of liability of its members. B. On the basis of the number of members. Kinds of a company. On the basis of the liability of its members. On the basis of the liability of its members, a company can be divided into three categories. Companies limited by shares, companies limited by guarantee, and unlimited companies. Companies limited by shares. In this case, the liability of a member is limited to the extent of the nominal value of the shares held by the members. Suppose the member pays off the full amount of his shares, then he is not liable to pay any amount to the company in spite of debts of the company. He does not need to pay any amount from his private property. Companies limited by guarantee. In this case, the liability of its members is limited to the amount they decide to at the time of winding up of the company. Thus, the liability of the members will be only in the event of its winding up. Unlimited companies. The unlimited company is the company in which there is no limit on the liability of its members. In this case, if the company's property is not enough to pay off its debts, then the private property of the members can be used for this purpose. In other words, the creditors have the right to claim their dues from its members. Such companies are not found in India, even though permitted by the Companies Act 1956. Kinds of a company. On the basis of number of members. On the basis of number of members, a company can be divided into two categories on the basis of number of members. Public company. A public company means a company which is not a private company, has minimum capital of 5 lakh rupees. On such higher paid up capital may be prescribed and is not a subsidiary of a private company. Private company. A private company is the company which has minimum paid up capital of 1 lakh rupees or such higher paid up capital as may be prescribed by its articles. It restricts the right of transfer of shares, must have at least 2 persons except in case of 1-person company, limits the number of its members to 200 excluding employees. Don't let the public to subscribe for any shares in or debentures of the company. Don't accept deposits from a person other than its members, directors and relatives. 1-person company. Under Section 262 of the Companies Act, an OPC is a company which has only person as its member. Rule 3 of the Companies Incorporation Rules 2014 provides that A. Only a natural person being an Indian citizen and resident in India can form 1-person company. B. It cannot carry out non-banking financial investment activities. C. Its paid-up share capital is not more than 50 lakh rupees. D. Its average annual turnover of 3 years does not exceed rupees 2 crores. Categories of share capital 1. In accounting, the share capital of the company can be divided into the following types. Authorized capital. This type of capital is the share capital which a company is authorized to issue by its memorandum of association A company does not have the permission to raise the capital more than specified by Memorandum of Association. It is also called as nominal capital or registered capital. The nominal capital can be increased or decreased as per the procedure of the same mentioned in Companies Act. It is not necessary for the company to issue the whole authorized capital for public subscription at a time. In case of need, the company may issue share capital as per requirement, but it should not be more than the amount of authorized capital. Issued capital. It is the amount of capital which is actually issued to the public for subscription, including the shares which are allotted to vendors and the signatories to the company's memorandum. The authorized capital for which public subscription is not invited is known as unissued capital. Unissued capital may be offered for public subscription at a later date. Subscribed capital. The part of the authorized capital which is offered to public for subscription is called as subscribed capital. When the shares that are offered for public subscription are subscribed fully by the public, the issued capital and subscribed capital would be the same. In case the subscribed capital is higher, then it will not reflect in the books of accounts. Categories of share capital 2. Called up capital. The part of the subscribed capital which has been called up on the shares is called called up capital. It is company's wish to call upon the entire amount or part of the face value of the shares. For example, if the face value of a share allotted is 15 rupees and the company called up only 10 rupees per share, then the called up capital would be 10 rupees per share and extra 5 rupees can be asked from the shareholders as and when it requires. Paid up capital. The portion of the called up capital that a company actually receives from the shareholders is known as paid up capital. If any of the shareholders have not paid amount on calls, such an amount may be called as calls in arrears. Therefore, paid up capital is equal to the called up capital minus call in arrears. Uncalled capital. The portion of the subscribed capital which yet is to be called up is called as unsubscribed capital. It can be collected by the company as and when required. Reserve capital. A company at times reserves some amount of its uncalled capital to be called at the time of winding up of the company, which is known as reserve or reserve capital. It is available only for the creditors on winding up of the company. Nature and classes of shares. What is a share? Share can be defined as a unit in which the total share capital of a company is divided. The person who contributes money to the company through shares is called a shareholder. As per Section 86 of the Companies Act, a company can issue two types of shares: preference share, equity shares. Preference shares. As per Section 85 of the Companies Act, a preference share is one that fulfills the following conditions. A. It carries a preferential right to dividend before paying the dividend to equity shareholders. B. It carries a preferential right to get capital payment before any payment made to equity shareholders at the time of winding up of the company. A holder of the preference shares has the right to participate in the surpluses of the company, fully or to a limited extent, as prescribed by Memorandum of Association. These shares can be redeemable or irredeemable, cumulative or non-cumulative, or participating or non-participating. Equity shares. According to Section 85 of the Companies Act, an equity share is one which is not a preference share. The shares that don't have any preferential right of payment of dividend or repayment of capital are termed as equity shares. The equity shareholders are entitled for the distributable profits of the company after giving the dividend to the preference shareholders. The dividend which is given to equity shareholders may vary depending upon the amount of profits available for distribution. Steps in the procedure of share issue 1. The amount on a company's shares can be gradually collected in easy installments spread over a period of time depending upon the growing financial requirement of a company. The first installment is collected while accepting the application, and that's why known as application money. The second on allotment, termed as allotment money, and the remaining installment are termed as first call, second call, and so on. The word final is suffixed to the last installment. Steps in the procedure of share issue. Issue of prospectus. Prospectus is a way of giving information about the company to the public. Through prospectus, a company invites the public for investing and making them aware of the existence of the company. It provides complete information about the company and the way money is to be collected from the investors. Receipt of applications. When people are invited through prospectus, then the investors who are willing to subscribe the share capital of the company would make an application along with the application money and deposit the same with the scheduled bank as mentioned in the prospectus. The company should get the minimum subscriptions within 120 days from the date of issue of the prospectus. If the company fails to receive the same, the company cannot proceed for the allotment of shares, and application money should be returned within 130 days of the date of issue of prospectus. Steps in the procedure of share issue. 2. Allotment of shares. In case of minimum subscription received, the company may go ahead for the allotment of shares after fulfilling certain other legal formalities. Letters of allotment will be given to those whom the shares have been allotted, and letters of regret to those to whom no allotment has been made. When allotment is made, it generates a valid document between the company and the applicants who now become the shareholders of the company. Shares of a company can be issued at par or at premium price. When the issue price of share is exactly equal to their nominal value according to the terms and conditions of issue, then shares will be issued at par. When the shares of a company are issued more than its nominal value, face value, the excess amount is called premium. Accounting treatment on application. The money paid as installments shows the contribution to share capital and should be credited to share capital. However, to avoid inconvenience, initially individual accounts are opened for each installment. All money received along with application is deposited with a scheduled bank in a separate account opened for the purpose. Accounting treatment of allotment. When a company receives minimum subscription and certain legal formalities on the allotment of shares have been duly done, the directors of the company proceed to make the allotment of shares. The allotment of shares implies a contract between the company and the applicants, who now become the allottees and have the status of shareholders or members. Journal entries with regard to allotment of shares. Journal entries for allotment of shares. 1. For transfer of application money. 2. for money refunded on rejected application. 3. For amount due allotment. 4. For adjustment of excess application money. 5. For receipt of allotment money. Sometimes a combined account for share application and share allotment, called share application and allotment account, is opened in the books of a company. When a combined account is maintained, journal entries are recorded in the following manner. 1. For receipt of application and allotment. 2. For transfer of application money and allotment amount due. 3. For money refunded on rejected application. 4. On receipt of allotment account. Accounting treatment for on-calls. Calls play an important role in making shares fully paid up and for realizing the full amount of shares from the shareholders. If the shares are not fully called up till the completion of the allotment of shares, then the directors have the right to ask for the balance amount on shares as and when they decide about the same. 2 points should keep in mind regarding the call on shares. The amount on any call should not exceed 25% of the face value of shares. There must be an interval of at least 1 month between the makings of 2 calls unless otherwise provided by the Articles of Association of the company. Journal entries with regard on-call shares. Journal entries for on-call shares. 1. For call amount due. 2. For receipt of call amount. Please note that the word first, second or third must be added between the words share and call in the share call account depending upon the identity of the call made. Suppose in case of first call, it should be written as share first call account, etc. Another point to be noted is that the words the and final will also be added to the last call. Say, if third call is the last call, it will be termed as third and final call. Call in arrears. When any shareholder is not able to make the payments due on allotment or any of the calls, then that amount will be treated as call in arrears or unpaid calls. If a company maintains accounts for call in arrears account, then the following entries would be made. The Articles of Association of a company may give the rights to the directors to charge interest at a stipulated rate on calls in arrears. If the articles does not say anything in this regard, then interest not exceeding 10% per annum shall have to be paid on all unpaid amounts on shares for the period intervening between the day fixed for payment and the time of actual payment made. When the shareholder makes the payment of calls in arrears together with interest, the entry will be as follows. Call in advance. At times, shareholders pay a part or the whole of the amount of the calls which are not made by the company. The amount which is received from the shareholders in advance is known as calls in advance. The amount received in advance is a liability of the company and should be credited to call in advance account. The amount received as call in advance will be adjusted towards the payment of calls when they become due. The journal entries for the calls in advance would be: when the calls become due, then the entry would be done as follows. Calls in advance account is shown as a separate item under the title Equity and Liabilities in the company's balance sheet, under the head Current Liabilities, under Other Current Liabilities. If mentioned in the articles, to pay interest on call in advance from the date of its receipt up to the date when appropriate call is due for payment. The entry would be done as follows. For payment of interest, for interest due, for interest paid. Oversubscription. At times, there are situations when applications for more shares of a company are received than the number of shares offered to the public to subscribe. Generally, it happens in the case of a well-established company or the companies which are financially strong, and is called as a case of oversubscription. Oversubscription. In case of oversubscriptions, 3 alternatives are available with the directors to deal with the situations. 1. They can accept some applications in full and reject other applications. In that case, the application money received on rejected applications may be fully refunded. The journal entries will be done as follows. 1. Money received on application. 2. Transfer of application for money. 3. For amount due on allotment. 4. Allotment money received. 2. When the directors choose to make a called pro rata allotment. In this case, the excess application money received is adjusted against the amount due on allotment. In case the excess application money received is more than the amount due on allotment of shares, such excess amount may either be refunded or credited to calls in advance. The journal entries in this case would be 1. For application money received. 2. Transfer of application money to share capital and the excess application money on shares credited to share allotment account. 3. Amount due on allotment. 4. Allotment money received after adjustments. 3. When the application for some shares are rejected directly and pro rata allotment is made to the remaining applicants, the money on rejected applications is refunded and the excess application money received from applicants to whom pro rata allotment has been made is adjusted towards the amount due on the allotment of shares allotted. Undersubscription. Undersubscription is that situation where number of shares applied for is less than the number for which applications have been invited for subscription. For example, a company offered 3 lakh shares for subscription to the public, but the applications were received for 2,90,000 shares only. In such a situation, the allotment will be confirmed to 2,90,000 shares and entries shall be made accordingly. Issue of shares at premium. Issue of shares at premium means issuing shares at the amount more than the par value. When a share of the nominal value of rupees 100 is issued at rupees 115, it is said to have been issued at a premium of 15%. When the company issues share at premium, then it can call the premium amount at any point. The amount of premium is credited to a separate account called Securities Premium Account and is shown under the title Equity and Liabilities of the company's balance sheet under the head Reserves and Surpluses. Purpose for which premium can be utilized. A. To issue fully paid bonus shares, not more than unissued share capital. B. To write off preliminary expenses of the company. C. To write off expenses like commission paid, discount allowed, etc. D. To pay premium on the redemption of preference shares. E. To purchase own shares. For premium amount called up with application money, premium amount called with allotment money, premium amount called with call money. Issue of shares at discount. There are many situations when a company issues shares at a discount, means amount less than the par value of share. Suppose a 120 rupees share of company is issued at a price of rupees 100. A company cannot normally issue share at discount. It can only issue shares on discount in the case of reissue of forfeited shares. Issue of shares for consideration other than cash. There are cases when a company makes an arrangement with the vendors from whom it has purchased assets, in which the vendor accepts the payment in the form of fully paid shares of the company issued to them. Normally, no such cash is received for issue of shares. These shares can also be issued either at par, at premium, or at discount, and the number of shares to be issued will depend upon the price at which the shares are issued and the amount payable to the vendor. The formula to calculate the number of shares that are issued to vendor is given here. Forfeiture of shares. At times, it happens that some of the shareholders fails to pay installment money or call money. In that cases, a company can forfeit their shares, which means company can cancel their allotment. When shares are forfeited, all entries relating to the shares forfeited, except those relating to premium already recorded in the accounting records, must be reversed. Forfeit of shares. Journal entry for forfeiture of shares. Forfeit of shares issued at par. It may be noted here that when the shares are forfeited, all entries relating to the forfeited shares will be reversed except the entry relating to share premium received. Forfeiture of shares issued at premium. If shares are issued at premium and the amount of premium is realized fully, but some shares are forfeited because of non-payment of call money, then the accounting treatment will remain the same as we do when shares are issued at par. The securities premium account is not to be debited at the time of forfeiture if the premium has been received in respect of the forfeited shares, and the amount of forfeiture shall be excluding premium amount. If the premium amount is not received for forfeited shares, then the securities premium reserve account will also be debited with the amount of premium not received along with the share capital account at the time to forfeiture. The journal entries would be done as follows. Reissue of forfeited shares. Forfeited shares may be reissued as fully paid at a par, premium and discount. But it may be noted that the amount of discount cannot allowed more than the amount received at the time of issue of shares, and the discount allowed on reissue of forfeited shares should be debited to the forfeited share account. The balance, if any, left in the share forfeited account relating to reissued shares should be treated as capital profit and transferred to capital reserve account. The journal entry would be Summary. Let us summarize what we have learned in this module. A company is a person, artificial, invisible, intangible, and existing only in the eyes of law. Being a mere creation of law, It possesses only those properties which the charter of its creation confers upon it, either expressly or as incidental to its very existence. The members of the company are liable for the unpaid amount of the shares held by them. The death or insanity or insolvency of any member of the company in no way affects the existence of the company. A company can enter into contracts and can take legal rights against the others in case of any breach of contract. The unlimited company is the company in which there is no limit on the liability of its members. On the basis of the number of members, company can be divided into a public company and private company. Under Section 262 of the Companies Act, an OPC is a company which has the only person as its member. Issued capital is the amount of capital which is actually issued to the public for subscription, including the shares which are allotted to vendors and the signatories to the company's memorandum. The part of the authorized capital which is offered to the public for subscription is called as subscribed capital. The part of the subscribed capital which has been called upon the shares is called as called up capital. A prospectus is a way of giving information about the company to the public. When the issue price of a share is exactly equal to their nominal value according to the terms and conditions of an issue, then shares will be issued at par. When the shares of a company are issued more than its nominal value, face value, the excess amount is called premium. When any shareholder is not able to make the payments due on allotment or any of the calls, then that amount will be treated as call in arrears or unpaid calls. The learning objectives. After studying this learning module, learners will be able to understand the meaning of debentures and difference between debentures and shares. Know the types of debentures. Know the different accounting treatments for debentures issued at par, premium or discount. Understand the concept of issue of debentures other than cash. Learn the concept of issue of debentures as collateral security. Explain the methods of writing off discounts loss on issue of debentures. Know the methods of redemption of debentures and accounting treatments. Understand the concept of sinking fund. Issue and redemption of debentures. Meaning of debentures. The word debenture is derived from a Latin word debere, which means to borrow. Debenture is a written document that acknowledges a debt under the common seal of the company. It includes a contract for repayment of principal after a specified period of time, or at specified interval, or at the option of the company, and for payment of interest at a fixed rate, payable usually either half-yearly or yearly on fixed dates. According to Section 2, Subsection 12 of the Companies Act 1956, debenture includes debenture stock, bond sand, and any other securities of a company, whether constituting a charge on the assets of the company or not. According to Topham, debenture is a document given by a company as evidence of debt to the holder, usually arising out of a loan, and most commonly secured by a charge. What is bond? This is also an instrument used for debts, but these days this is used by semi-government or non-government organization. Difference between shares and debentures. There are many differences between the shares and debentures. Ownership. A debenture holder is a loan creditor of the company, whereas a person who is having the share of the company has become the owner of the company. Because a share is the part of the capital owned, whereas a debenture is the borrowed capital. Difference between shares and debentures. Return. A return on shares is called as dividend, while a return on debentures is called interest. The rate of interest paid to the company for debentures is pre-decided, whereas the rate of interest on shares may vary depending upon the profit of the company. The payment of dividend depends upon profit, whereas the payment of interest is to be paid even if there is no profit. Repayment. Generally, the amount of shares is not required to be repaid during the lifetime of the company, but the debentures are issued for a time period, and after the expiry of the time period, the amount is to be repaid. However, an amendment in 1998 to the Companies Act 1956 has permitted the companies to buy back its own shares from the market, particularly when the price of its share in the market is lower than the book value. Voting rights. Shareholders enjoy voting rights in the company, whereas debenture holders do not have any voting rights in the company. Security shares are not secured by any kind of charge, whereas the debentures are generally secured by a fixed or floating charge over the assets of the company. Convertibility. Shares cannot be converted into debentures, whereas debentures can be converted into shares if mentioned in the terms of the issue, and in that case, these are known as convertible debentures. Types of debentures on the basis of security and tenure. Types of debentures. A company can issue different kind of debentures as per the requirement, which are as follows. From the point of view of security, in this category, debentures can be divided into two categories. A. Secured debentures. Secured debentures are the debentures for which a charge is created on the assets of the company in case of payment defaulters. The charge may be fixed or floating. The fixed charge is created for those assets which are held by a company for use in operations, not meant for sale, whereas the floating charge is levied on all assets excluding those assigned to the secured creditors. B. Unsecured debentures. In unsecured debentures, there is no specific charge on the assets of the company, but at times a floating charge can be created on these debentures by default. Normally, these kinds of debentures are not issued. From the point of view of tenure, in this category again debentures can be classified as A. Redeemable debentures. These are those kinds of debentures which are payable at the time of expiry period in a lump sum or in installments during the lifetime of the company. Debentures can be redeemed either at par or at a premium. B. Irredeemable debentures. In this kind of debentures, the company does not give any commitment for repayment of money borrowed by issuing debentures. These are redeemable at the time of winding up of the company. These debentures are also known as perpetual debentures. Types of debentures on the basis of convertibility and point of view coupon rate point. From the point of view of convertibility, in this category, the debentures can be divided into two categories. A. Convertible debentures. The debentures which can be converted into equity shares or in any other security are called as convertible debentures. These debentures are convertible either at the option of the company or the debenture holder. These debentures are either fully convertible or partly convertible. Non-convertible debentures. These debentures cannot be converted into shares or in any other securities. Most debentures issued by companies fall in this category. From coupon rate point of view, As per this category, the debentures can be divided into two categories. A. Specific coupon rate debentures. The debentures which are issued at a specific rate of interest are called as coupon rate debentures. The specified rate may either be fixed or floating. The floating interest rate is usually tagged with the bank rate. B. Zero coupon rate debentures. These debentures are not issued at a specific rate of interest. Such debentures are issued at a substantial discount to compensate the investors. In these kinds of debentures, difference between the nominal value and the issue price is treated as the amount of interest related to the duration of the debentures. Registered and unregistered debentures. From the point of view of registration, as per this category, the debentures can be divided as A. Registered debentures. These debentures are those debentures in which all details of the debenture holders like names, addresses and particulars of holding of debentures are entered and kept in a register by the company. Such debentures can be transferred only by executing a regular transfer deed. B. Unregistered debentures. These debentures are transferred by way of delivery, and the company pays the interest on debentures to the person who produces the interest coupon attached to the debentures. Issue of debentures. The debentures are issued in same procedure as we follow in issue of shares. The investors who are interested in applying for debentures, they apply on the prospectus issued by company. The company may either ask for the entire amount to be paid on application or by means of installments on application, on allotment and on various calls. Like shares, debentures can also be issued at par, at a premium or at a discount. They can also be issued for consideration other than cash or as a collateral security. Issue of debentures for cash. Debentures are said to be issued at par when their issue price is equal to the face value. The journal entries recorded for such issue are as under. If whole amount is received in one installment. 1. On receipt of application money. 2. On allotment of debentures. Issue of debentures on cash, discount and premium. If debenture amount is received in two installments, 1. On receipt of application money. 2. For adjustment of application's money on the allotment. 3. For allotment money due. 4. On receipt of allotment money. If debenture money is received in more than two installments. A. On making the first call. B. On receipt of the first call. Issue of debentures at discount. When a debenture is issued at a price below than the normal price, then it is said to be issued at discount. It will be treated as a capital loss and is shown under the line item Other Non-Current Assets or Other Current Assets, depending upon the time period in which it is to be written off. This discount amount is to be written off either by debiting it to profit and loss or out of securities premium reserve account, if any, during the lifetime of debentures. This amount is to be written off during 12 months of the data of the balance sheet. Debentures issued at premium. When a debenture is issued more than its normal price, then it is said to be issued at a premium. This extra amount is credited to securities premium reserve account and is shown on the liabilities side of the balance sheet under the head Reserves and Surpluses. Oversubscription. When the number of debentures offered to the public is less than the number of debentures applied by the people, then it is said oversubscription. The extra money received by the company on oversubscriptions be retained for making various adjustments for allotment and the respective calls. But the money received from applicants to whom no debentures have been allotted will be refunded to them. Issue of debentures for consideration other than cash. At times, a company purchases asset from vendors not on cash but issues debentures as consideration other than cash. In such cases also, the debentures can be issued at par, discount, or on premium. The entries would be done as follows. A. On purchase of assets. B. On issue of debentures. At par. At premium. At discount. At times a company take over or purchase liabilities of another concern. In such condition, the purchase consideration will be equal to the value of net assets taken over, and if the whole amount of the consideration is paid by issue of debentures, the journal entry will be issue of debentures as a collateral security. A collateral security can be defined as a secondary or additional security other than primary security when a company takes loan or overdraft from a bank or any other financial institution. If the value of primarily security is less than the value of loan, then the company may issue its own debentures to the lenders in addition to some other assets already pledged. Such an issue of debentures is known as debentures issued as collateral security. Terms of issue of debentures. Whenever a company issues debentures, it generally mentions the terms on which the debentures will be redeemed at the time of maturity. Redemption of debentures means giving the liability on account of debentures by repayment made to the debenture holders. Debentures can be redeemed either at par or at a premium. The common 6 situations that are found in issue and redemption of debentures are as follows. A. Issued at par and redeemed at par. B. Issued at discount and redeemed at par. C. Issued at premium and redemption at par. D. Issued at par and redeemed at premium. E. Issue at discount and redemption at premium. F. Issued at premium and redeemed at premium. Interest on debentures. When a company issues debentures, it is required to pay interest on debentures at the fixed percentage, half-yearly, periodically until debentures are repaid. Interest on debenture is a charge against the profit of the company and must be paid whether the company has earned any profit or not. According to Income Tax Act 1961, a company must deduct income tax at a prescribed rate from the interest payable on debentures if it exceeds the prescribed limit. It is called Tax Deduction at Source (TDS) and is to be deposited with the tax authorities. Accounting treatment for interest on debentures. The following entries will be made in the journal for interest on debentures. When interest is due. For payment of interest to debenture holders. On transfer debenture interest account to statement of profit and loss. On payment of tax deducted at source to the government. Writing off discount or loss on issue of debentures. The discount or loss on issue of debentures is not to be written off in the year debentures were issued. since the benefit of the debentures would earned by the company till their redemption. The discount or loss on it is therefore treated as capital loss. The discount may be charged to securities premium account or may be written off over 3 to 5 years through statement of profit and loss as per guidelines issued by ICAI. In case the capital profits are not sufficient, then this amount can be written off against the revenue profits. There are two methods that can be used to write off the loss or discount on debentures against revenue profits. A. Fixed installment method. In case the debentures are redeemed at the end of a specified period, the total amount of discount should be written off in equal installments of fixed amount over that period. B. Fluctuating installment method. The amount of discount under this method goes on reducing every year, and so this method may also be known as reducing installment method. When debentures are repaid biannually or in installments, the discount should be written off in the ratio of debentures outstanding as at the end of each accounting year. Redemption of debentures. Redemption of debentures means to repayment of the amount of debentures by the company. There are 4 ways to redeem the debentures. Payment in lump sum. The company can redeem the debentures by paying the lump sum amount to the debenture holders at the time of maturity. Payment in installments. Under this method, the debentures can be redeemed in installments on the specified date during the tenure of the debentures. The total amount of liability of debentures is divided by the number of years. Purchase in open market. In this way, the company purchases its own debentures for the purpose of cancellation. In this act, redemption of debentures done by purchase the debentures in the open market, conversion into shares or new debentures. A company can redeem its debentures by converting the debentures into shares or a new type of debentures. These new shares or debentures can be issued at par, at a discount, or at a premium. It is to be noted, if debentures were originally issued at discount, the actual amount realized from them at the time of issue would be used as the basis for computing the actual number of shares to be issued. It may be noted that this method is applicable only to convertible debentures. Consideration to be taken care for redemption. Factors to be taken care while redemption of debentures. Time of redemption of debentures. A company may redeem its debentures before the due date if the article of the company allows. Sources of redemption of debentures. The debentures can be sources either through capital or profits. Out of capital. The companies who got an exemption from creating DRR can redeem the shares from the capital. Out of profits. When any company planning to redeem its debentures purely out of profit, it should transfer 100% of the face value of the redeemable debentures to DRR out of the surplus available for payment of dividend, out of capital or profits. If a company redeems its debentures by using profits or capital partially, it does not transfer 100% of face value of outstanding debentures of a particular class to DRR out of the surplus available for payment of dividend. Journal entries for redemption by payment in lump sum. If debentures are to be redeemed at par. If debentures are redeemed at premium. As per the provisions of the Companies Act 2013, the company keep aside a part of profits every year and transfer it to debenture redemption reserve for the redemption of debentures until the debentures are redeemed. The following points should be taken care for journal entry. A. If a company has issued debentures, it shall create a debenture redemption reserve for the redemption of such debentures, and an adequate amount shall be credited from profits every year by the time debentures are redeemed. B. The amount credited to the debenture redemption reserve shall be used for redemption of debentures only. Debenture Redemption Reserve Account 1. According to Rule 18(7) of the Companies Rules 2014, the company should create a debenture redemption reserve keeping in mind the following conditions. A. The debenture redemption reserve should be created out of profits available for paying the dividend. B. The company should create DRR with as per the following conditions. 1. No DRR is required for debentures issued by All India Financial Institutions AIFIs regulated by Reserve Bank of India and banking companies for both public as well as privately placed debentures. 2. For NBFCs registered with the RBI and for housing finance companies registered with the National Housing Bank, DRR will be 25% of the value of outstanding debentures issued through public issue as present SEBI Issue and Listing of Debt Securities Regulations 2008, and no DRR is required in the case of privately placed debentures. 3. For other companies including manufacturing and infrastructure companies, the adequacy of DRR will be 25% of the value of outstanding debentures issued through the public issue as per present SEBI Issue and Listing of Debt Securities Regulations 2008. 4. 25% DRR is required in the case of privately placed debentures by listed companies. For unlisted companies issuing debentures on private placement basis, the DRR will be 25% of the value of outstanding debentures. Debenture Redemption Reserve Account 2. C. Every company required to create debenture redemption reserve shall on or before the 30th day of April in every year. It can invest or deposit a sum which shall not be less than 15% of the amount of its debentures maturing during the year ending on the 31st day of March of the next year, in any one or more of the following methods, namely: 1. Deposits with any scheduled bank, free from any charge or lien. 2. Securities of the central government or of any state government. 3. Securities mentioned in sub-clauses A to D and EE of Section 20 of Indian Trusts Act 1882. 4. Bonds issued by any other company which is notified under sub-clause F of Section 20 of the Indian Trusts Act 1882. 5. The amount invested or deposited as above shall not be used for any purpose other than for redemption of debentures maturing during the year. D. In case of partly convertible debentures, debenture redemption reserve shall be created in respect of non-convertible portion of debenture issue. Redemption by payment in installments. As per the Article of Association, the debentures are to be redeemed in installments beginning from a particular year. The actual debentures can be redeemed usually by the selected draw of lots, and the redemption to be made either out of profits or out of capital. The entries will be: if redeemed out of profit, if redeemed out of capital, Redemption by purchase in an open market. When a company purchases its own debentures in open market for the purpose of cancelling it, then the purchase and cancellation of such debentures is known as redemption by purchase in open market. The company can redeem its debentures whenever they have surplus funds or can purchase their debentures whenever they are available at discount in the market. The journal entries will be done as follows. On purchase of own debentures for immediate cancellation. On transfer of profit on redemption. If debentures are purchased from the market at a price which is above the nominal value of debenture, the excess will be debited to loss on redemption of debentures. The journal entry in that case is shown here. Redemption by conversion. We have already discussed that debentures can also be redeemed by converting them into shares or new debentures. These new debentures can be issued at par, discount or premium. It may be noted that no debenture redemption reserve is required in case of convertible debentures because no funds are required for redemption. Sinking fund method. A company needs sufficient funds to redeem debentures at the end of the specified time period. So, the company may create a sinking fund and start investing amount accordingly in securities or bonds of other business entities. Sinking fund method. In this method, the company keeps aside an equal amount every year from divisible profits so that necessary funds can be arranged every year at the time of redemption. This is called sinking fund method. The saved amount is invested by the company in marketable securities. An appropriate amount is calculated by referring to on sinking fund table depending upon the rate of return on investments and the number of years for which investments are made. The amount so calculated is transferred from profits every year to debenture redemption fund and its investment is termed as debenture redemption fund investment. These investments earn a certain amount of income, known as interest, which is reinvested together with the fixed appropriated amount. The debenture redemption fund investments are encashed and the amount which is received is used for the redemption of debentures. If company incurred any profit or loss out of the encashment of debenture redemption fund investments, that is also transferred to debenture redemption fund account. The steps used in working out sinking fund method. 1. Find out the amount of profit to be set aside every year with the help of the sinking fund method. 2. Keep aside the amount of profit at the end of every year and credit that to debenture redemption fund DRF account. Working of sinking fund method. Steps in working of sinking fund method. 1. Purchase the investments of the same amount at the end of the first year and debit debenture redemption fund investment DRFI account. 2. Receive interest on the amount invested at the end of each subsequent year. 3. Purchase the investments for the amount of profit set aside and the interest earned every year except last year, year of redemption. 4. Convert the investments into cash at the end of the year of redemption. 5. Transfer the profit or loss on sale of investments reflected in the balance of debenture redemption fund investment account to debenture redemption fund account. 6. Make payment to debenture holders. 7. Transfer debenture redemption fund account balance to general reserve. Journal entries would be done as follows. 1. At the end of the first year. A. for setting aside the fixed amount of profit for redemption. B. For investing the amount set aside for redemption. 2. At the end of the second year and subsequent years other than last year. A. For receipt of interest on debenture redemption fund investments. B. For transfer of interest on debenture redemption fund investment to debenture redemption fund account. C. For setting aside the fixed amount of profit for redemption. D. For investments of the amount set aside for redemption and the interest earned on DRFI. 3. At the end of last year. A. For receipt of interest. B. For transfer of interest on debenture redemption fund investment to debenture redemption fund investment account. C. For setting aside the fixed amount of profit for redemption. D. For encashment of debenture redemption fund investments. E. For the transfer of profit or loss on realization of debenture redemption fund investments. F. For amount due to debenture holders on redemption. G. For payment to debenture holders. H. For transfer of debenture redemption fund account balance to general reserve. Summary. Let us summarize what we have learned in this module. Debenture is a written document that acknowledges a debt under the common seal of the company. Bond is used by semi-government or non-government organization for debts. A debenture holder is a loan creditor of the company, whereas a person who is having the share of the company is become the owner of the company. Secured debentures are that kind of debentures for which a charge is created on the assets of the company in case of payment defaulters. In unsecured debentures, there are no specific charges on the assets of the company, but at times a floating charge can be created on these debentures by default. Redeemable debentures which are payable at the time of expiry period in lump sum or in installments during the lifetime of the company. In irredeemable debentures, the company does not give any commitment for repayment of money borrowed by issuing debentures. The debentures which can be converted into equity shares or in other security are called as convertible debentures. These debentures cannot be converted into shares or in any other securities. The debentures which are issued at a specific rate of interest are called as coupon rate debentures. Registered debentures are those debentures in which all details of the debenture holders like names, addresses, and particulars of the holding of debentures are entered and kept in a register by the company. Debentures are said to be issued at par when their issue price is equal to the face value. When a debenture is issued at a price below than the normal price, then it is said to be issued at discount. When a debenture is issued more than its normal price, then it is said to be issued at premium. When the number of debentures offered to the public is less than the number of debentures applied by the people, then it is said oversubscription. Learning objectives. After studying this module, students will be able to state the meaning of accounting ratios, learn the objectives and limitations of accounting ratios, know the types of accounting ratios, understand how to calculate the different types of ratios. Introduction to accounting ratios. The comparative statements, common size statements, trend analysis, accounting ratios, and cash flow statements are considered as the common tools for the financial statement analysis of an organization. Here, we learn accounting ratios that help us to know about the company's solvency, efficiency, and profitability. Meaning of accounting ratio. A ratio is a mathematical number that helps to calculate the relationship of two or more numbers. The ratio can be expressed in percentage, fraction, proportion, and a number of times. In accounts, when we calculate a number by referring to accounting numbers which are taken from a financial statement are called as accounting ratios. Objectives of ratio analysis. Ratio analysis is the important for interpreting results given by financial statements. It provides important financial information to the users and also tells areas that need investigations. Ratio analysis involves regrouping of data by applying arithmetic relationships. It is a complex process and requires fine understanding of the rules used for financial statements. It provides comprehensive information to the analyst, such as to know areas of the business that requires attention, to know the areas that can be improved with the desired direction, to provide a deep analysis of profitability, efficiency, and solvency of the business, to compare the performance with the best industry standards, to provide information for projections and estimates for the future. Advantages of ratio analysis. Ratio analysis improves the user's efficiency of conducting business. When a property is analyzed, the ratios make us understand various problem areas and bright spots of the business. The problem areas help management to make the situation better in the future and take care of such things. There are many advantages of ratio analysis. Helps to understand the efficacy of decisions. The ratio analysis tells whether the organization has taken the right kind of financial, operational, and investing decisions and help them to improve, simplify complex figures, and establish relationships. Ratio analysis simplifies complex accounting figures and summarizes the financial information effectively. It helps to assess firms' earning capacity, managerial efficiency, and creditworthiness. Helpful in comparative analysis. The ratio is not calculated for 1 year, but they help to explore the trends in year by year. These trends help to make projections about the business in the future. Identification of problem. Ratio analysis help in finding out problem areas as well as bright areas of the business, so that the problem areas can be improved and better areas can be more polished. Enabled SWOT analysis. Ratios tells about the changes in the business so that management can do strength and weakness analysis of their business to find the threats and opportunities of the business. Various comparisons. Ratio analysis helps to set benchmarks for the business and later to assess the business performance whether it is better or not. The solvency, profitability of the business is compared over the years within the organizational targets, with other organizations, and with standards that are set for the organization. Limitations of ratio analysis. Limitations of ratio analysis that arise from financial statements. As the ratios are calculated from the financial statements, so any issue in the financial statement will also creep in the derived analysis. There are certain limitations of the ratio analysis. Limitations of accounting data. Accounting data reflect a recorded fact, accounting conventions, and personal judgments all combined together. For example, profit of the business is not a precise and final figure. It is just an opinion of the accountant after applying accounting policies. So, the financial statements may not reveal the true state of affairs of the enterprises. And so, the ratios will also not give the true picture. Ignore price level changes. The financial accounting applies stable money measurement principle. It assumes that price level changes are either non-existent or minimal. But the truth is that we are living in an inflated economy where the value of money declines constantly. A change in the price level makes an analysis of the financial statement of different accounting years meaningless because accounting records do not take into consideration changes in the value of money. Ignore qualitative or non-monetary aspects. Accounting covers only monetary aspects of business. Hence, the ratios also reflect only the monetary aspects, ignoring completely the non-monetary factors. Variation in accounting practices. We follow different accounting policies for the valuation of inventory, calculating depreciation, etc. These variations leave a big question on the cross-sectional analysis. As there are variations in accounting practices in different business enterprises, a valid comparison of their financial statements is not possible. Forecasting. Forecasting of future trends on the basis of historical analysis is not feasible. Proper forecasting requires consideration of non-financial factors as well. Limitations of ratios. Now let's know some limitations of ratios. There are many limitations of ratios. Means and not the end. Ratios are means to reach an end, not an end itself. Lack of ability to resolve problems. The ratios are indicative and do not provide a solution for the problems. Lack of standardized definitions. There is a lack of standardized definitions of concepts used in ratio analysis. For example, there is no standard definition of liquid liabilities. Lack of universally accepted standard levels. There is no universal standard which tells the level of ideal ratios. Universally acceptable, and in India, the industry averages are also not available. Ratios based on unrelated figures. A ratio calculated for unrelated figures would be a meaningless effort. Types of ratios. The ratios can be classified as traditional classification and functional classification. On the basis of traditional classification, the ratios can be classified as statement of profit and loss ratios. When we take a ratio of two variables from the statement of profit and loss, is known as the statement of profit and loss ratio. For example, the ratio of gross profit to revenue from operations is known as gross profit ratio. Balance sheet ratios. When both the variables are from the balance sheet, then they are called balance sheet ratios. For example, ratios of current assets to current liabilities, known as current ratio. Composite ratio. It is a combination of two ratios from different statements, like one variable from the statement of profit and loss and another variable from the balance sheet. It is called composite. Types of ratios. Functional classification of ratios. The functional classification is based on the purpose for which the ratio is calculated. Liquidity ratio. We know that the business needs liquid funds. The ability of business to pay the amount which is due to investors is known as liquidity, and the ratios that measure liquidity is known as liquidity ratios. These are short-term in nature. Solvency ratios. A business's ability to meet its contractual obligations towards external stakeholders is known as solvency, and the ratio calculated to measure solvency position are called as solvency ratios. Turnover ratios. The ratios that are calculated for measuring the efficiency of the business operations on the basis of effective utilization of resources. Profitability ratios. It refers to the analysis of profit with reference to revenue from operations of funds employed in the business, and the ratios calculated to meet this objective are known as profitability ratios. Liquidity ratios. These ratios are calculated to measure the short-term solvency of the business whether the firm is able to meet its current obligations or not. These are calculated on the basis of amount of current assets and current liabilities in the business. It consists of two ratios: A. Current ratio and B. Quick ratio. Current ratio and quick ratio. Current ratio. It is the ratio of current assets to current liabilities. It is written as: current assets include current investments, inventories, trade receivables, prepaid expenses, advance tax, and accrued income, etc. Current liabilities include short-term borrowings, creditors and bill payables, other current liabilities, and short-term provisions. Significance of current ratio. The current ratio should be reasonable. It should neither be very high or very low. A very high current ratio implies heavy investment in current assets, and it reflects underutilization or improper utilization of resources. A low ratio endangers the business and puts it at risk of facing a situation where it will not be able to pay its short-term debt on time. Quick ratio. It is the ratio of quick assets to current liabilities. The assets that can be quickly converted into cash are called as quick assets. While calculating quick assets, we exclude the prepaid expenses, inventories at the end, etc. It is calculated to give a check on the liquidity position of the business and is therefore also known as acid test ratio. Significance of quick ratio. The ratio provides a way to measure the capacity of the business to meet its short-term obligations without any flaw. Solvency ratios. The person who lends money to the business expects timely payment of his interest and repayment of the amount of principal at the end of the loan period. Solvency ratios are calculated to find out the ability of the business to service its debt in the long run. The following solvency ratios are calculated to find out the solvency of the business. Types of solvency ratios. Solvency ratios can be divided into the following categories. Debt-equity ratio. This ratio measures the relationship between long-term debt and equity. For security, capital structure with less debt and more equity is considered favorable as it reduces the chances of bankruptcy. It is calculated as long-term debts upon shareholders' funds. Significance of debt-equity ratio. This ratio measures indebtedness of an enterprise and tells the long-term lender regarding the extent of security of the debt. As discussed earlier, a low debt-equity ratio reflects more security. A high ratio, on the other hand, is considered risky. However, from the perspective of owners, greater use of debt ensures greater returns for them if the rate of earnings on capital employed is higher than the rate of interest payable. Debt ratio. The debt ratio refers to the ratio of long-term debt to the total of external and internal funds. It is computed as follows: long-term debts upon capital employed. Significance of debt to capital employed ratio. Debt-equity ratio shows the ratio of long-term debts in the capital employed. Low ratio means lenders are secure and high ratio helps management in trading on equity. The debt ratio can also be computed in with regard to total assets. In that case, it usually refers to the ratio of total debts. Proprietary ratios. Proprietary ratio depicts the relationship of shareholders' funds to net assets. The formula to calculate the proprietary ratio is significance of proprietary ratios. Higher the ratio of shareholders' funds in financing the assets, the more security it will provide to the creditors. Total assets to debt ratio. This ratio calculates the extent of the coverage of long-term debts by assets. The higher total assets to debt ratio means that assets have been financed by owners' funds and the long-term loan is adequately covered by assets. Significance of total assets to debt ratio. This ratio mainly indicates the rate of external funds in financing the assets and the extent of coverage of their debts are covered by assets. Interest coverage ratio. This ratio deals with the servicing of interest on loan. It is a way to measure the security of interest payable on long-term debts. It expresses the relationship between profits available for payment of interest and the amount of interest payable. Significance of interest coverage ratio. It tells the numbers of times interest on long-term debts is covered by the profits available for interest. A higher ratio ensures safety of interest on debts. Activity or turnover ratio. These ratios tell the speed of activities of the business. These ratio expresses the number of times the assets are employed and if any assets are turned into sales during the accounting period. Higher turnover ratio depicts better utilization of assets and signifies improved efficiency and profitability, and as such are known as efficiency ratios. Types of activity ratios. The important activity ratios are as follows. Inventory turnover ratio. This ratio calculates the number of times out of operations inventory is converted into revenue during an accounting period. It tells the relationship between the cost of revenue from operations and average inventory. Significance of inventory turnover ratio. It is used to measure the liquidity. How many times the inventory is purchased and replaced during the year. Low turnover of inventory can be because of bad buying, obsolete inventory, etc. And high turnover is good, and it may be because of buying in small lots or selling quickly at low margin to realize cash. Trade receivables turnover ratio. The ratio that tells the relationship between credit revenue from operations and trade receivables is called as trade receivables turnover ratio. Significance of trade receivables turnover ratio. The speed at which the trade receivables are realized determines the liquidity position of the company. It tells the number of times the receivables are turned over and converted into cash in an accounting period. Higher turnover means speedy collection from trade receivables. Trade payable turnover ratio. Trade payables turnover ratio tells the pattern of payment of trade payable. A trade payable is created out of credit purchases and it expresses relationship between credit purchases and trade payable. Significance of trade payable turnover ratio. It tells the average payment period. Lower ratio means credit allowed by the supplier is for a long period or delayed payment to suppliers which may affect the reputation of the business. Types of activity ratios. Net assets or capital employed turnover ratio. It reflects relationship between revenue from operations and capital employed in the business. Higher turnover means better activity and profitability. Significance of net assets turnover ratio. High turnover of capital employed, working capital and fixed assets is a good sign and implies efficient utilization of resources. Higher turnover reflects efficient utilization resulting in higher liquidity and profitability in the business. Profitability ratio. Profitability ratio helps to know the earning capacity of the business by utilizing the resources of the business. There is a relationship between the profit and the efficiency with resources are utilized in the business. Types of profitability ratio. There are various types of profitability ratio. Let us discuss them one by one. Gross profit ratio. Gross profit ratio is a percentage of operations and revenues, which is also known as gross margin. Significance of gross profit ratio. It indicates gross margin on selling of products. It also indicates the margin available to cover operating expenses, non-operating expenses, etc. Change in gross profit ratio happens due to change in selling price or cost of revenue from operations or a combination of both. Operating ratio. It is calculated to find out cost of operation with respect to revenue from operations. Operating profit ratio. This ratio helps to calculate operating margin. Significance of operating profit ratio. This ratio helps to analyze the performance of the business and reflects the operational efficiency of the business. It is useful for inter-firm and intra-firm comparisons. Net profit ratio. This ratio shows a relation of revenue from operation to net profit after deducting all the operational as well as non-operational expenses and incomes. Significance of net profit ratio. It tells about the profitability of the business and used in computation of return on investment. It also tells about the overall efficiency of the business. Return on capital employed or investment. This ratio tells about the overall utilization of the funds by the organization. Capital employed means long-term funds employed in the business, like shareholders' funds, debentures, and long-term loans. Capital employed may be considered as total of non-current assets and working capital of the business. Significance of return on capital employed ratio. It measures return on capital employed in the business. It tells about the efficiency of the business in utilization of funds invested by shareholders, debenture holders, and long-term loans. It also helps in inter-firm comparison. Return on shareholders' funds. This ratio is very important from shareholders' point of view, as they want to know whether their investment in the firm generates a reasonable return or not. The return should be higher than the return on investment. Otherwise, it would reflect that the company's funds have not been employed profitably. Earning per share. The earning per share refers to the amount of profit that is available to the equity shareholders. It is important to calculate earnings per share as it is important for the equity shareholders to know and also in stock market to know the price of the share. The profit that is considered for the EPS is the profit calculated after deducting the dividend on preference shares. This ratio is important to do the comparisons and also the ability of business to pay dividends. Book value per share. This ratio is again important for equity shareholders as it reveals about the value of holdings of equity shareholders and the effect of market price on shares. Equity shareholders' fund are calculated after deducting preference share capital from shareholders' funds. Dividend payout ratio. This ratio calculates the share of earnings that are distributed to the shareholders. This ratio tells about the company's dividend policy and the growth in owners' equity. Price-earnings ratio. This ratio reflects whether the growth of firm's earnings and reasonableness of market price of the shares is as per investors' expectation or not. The ratio may vary from company to company or industry to industry. In same industry depends upon the perception of investors of their future. Summary. Let us summarize what we have learned in this module. A ratio is a mathematical number that helps to calculate the relationship of two or more numbers. Ratio analysis provides important financial information to the users and also tells areas that need investigations. Ratios makes us understand various problem areas and bright spots of the business. The ratio analysis tells whether the organization has taken the right kind of financial, operation and investing decisions and helps them to improve. Ratio analysis simplifies complex accounting figures and summarize the financial information effectively. Accounting data reflect a recorded fact, accounting conventions and personal judgments all combined together. The ability of the business to pay the amount which is due to investors is known as liquidity, and the ratios that measures liquidity is known as liquidity ratios. A business's ability to meet its contractual obligations towards external stakeholders is known as solvency, and the ratio calculated to measure solvency position are called as solvency ratios. The ratios that are calculated for measuring the efficiency of the business operations on the basis of effective utilization of resources is called efficiency ratio. Solvency ratios are calculated to measure the short-term solvency of the business, whether the firm is able to meet its current obligations or not. The assets that can be quickly converted into cash are called as quick assets. Solvency ratios are calculated to find out the ability of the business to service its debt in the long run. Proprietary ratio depicts the relationship of shareholders' funds to net assets. The ratio that tells the relationship between credit revenue from operations and trade receivables is called the trade receivables turnover ratio. Trade payables turnover ratio tells the pattern of payment of trade payables. Profitability ratio helps to know the earning capacity of the business by utilizing the resources of the business. Learning objectives. After studying this module, students will be able to understand the purpose of cash flow statement. Describe the main objectives of cash flow statement. Know the difference between financial, operating and investing activities. Understand the way to prepare the cash flow statement. Know the methods to prepare cash flow statements. Know how to make cash flow statements using the direct and indirect method. Cash flow statement introduction. Financial statement reflects the financial position of the business and income statement shows the operational activities of the organization over a period of time. But with the help of cash flow statement, we come to know the inflow and outflow of cash or equivalent to cash. Accounting Standards 3 AS3 issued by the Institute of Chartered Accountants of India ICAI in June 1981, it is compulsory for all the listed companies to prepare and present a cash flow statement along with other financial statements annually. A cash flow statement divides the cash flows into operating, investing, and financial activities. It is required that an organization should prepare cash flow statement annually with other financial statements. Objectives of cash flow statements. A cash flow statement shows incoming and outgoing of cash and cash equivalents. The objective of the cash flow statement is to provide useful information about cash inflows and outflows to the organization under various categories like operating activities, investing activities, and financial activities. This information helps users to know the ability of the enterprise to generate cash and cash equivalents and how the organization utilizes those cash flows. Many economic decisions are taken by users after evaluating the ability of an enterprise to generate cash and time. Certainty in the generation of cash or cash equivalents. Benefits of cash flow statements. A cash flow statement provides the following benefits. A cash flow statement, along with other statements, helps a user to measure the changes in the net assets of the company, its financial structure and ability. Cash flow statement tells about the ability of the organization to generate cash and cash equivalents. It also helps users to compare the present cash inflows of different organizations. The cash flow statements also improve the capability of the reporting of operating performance by different organizations because it removes the effect of using different accounting procedures for same transactions. It also helps in balancing its cash inflows and cash outflows as per the changed conditions. It also checks the accuracy of the past assessments done for cash flows. Cash equivalents and cash flows. Cash equivalents. As we know, cash flow statement shows inflow and outflow of cash or cash equivalents from different activities of the organizations. The cash means cash in hand and demand deposits with the banks, and cash equivalent means short-term highly liquid investments that can be easily converted into cash and which have the risk of changes in the value. An investment is called as cash equivalents only when it has a short maturity, like 3 months or less from the date of acquisition. Cash flows. Cash flow means circulation of cash in and out because of some non-cash items. When we receive cash from a non-cash item, that is known as cash inflow. When we make payment in cash for such items, that is known as cash outflow. For example, purchase of goods by paying cash is cash outflow, while amount received from sale of machinery is cash inflow. Classification of activities for cash flow statement. 1. As per AS3, the activities in the cash flow statements can be divided into 3 categories: operating, investing, and financial activities. To let user know the effect of these activities on the financial position of the organization. Cash from operating activities. As per AS3, operating activities are those activities that involve the primary activities of an organization. Like for a business unit involved in manufacturing, the operating activities are manufacturing expenses, raw material expenditure, sale of clothes. These are considered as main activities of the business. The cash operations are indicator to know that the organization has generated sufficient cash flows to pay dividend, repayments of loan and making new investments. Cash flows from the operating expenses are generally derived from main activities. Examples of cash flows from operating activities are as follows. Cash inflows from operating expenses. Cash from sale of goods and giving services. Cash received from royalties, commission and other revenues. Cash outflows from operating expenses. Cash payment for goods and services purchased to suppliers. Cash payment to employees. Cash payment for insurance premiums and claims. Cash payment for tax. The net position of the organization is shown as operating cash flows. Cash from investing activity. AS3 defines investing activities as acquiring the disposing of long-term assets and other assets that are not included in cash equivalents. Investing activities includes sale and purchase of long-term assets or fixed assets like machinery, land, building and furniture, etc. Classification of activities for cash flow statement. Cash outflows from investing activities. Cash payments to get fixed assets tangible as well as intangible assets. Cash payments made for shares, debt instruments and warrants. Cash advances and loan paid to third parties. Cash inflows from investing activities. Cash received from disposing of fixed assets. Cash received from the repayment of loans or advances made to third parties. Cash received from disposal of shares and debenture warrants. Interest received in cash from loans and advances. Dividend received from investments. Cash from financing activities. Cash from financing activities include capital or long-term funds of an enterprise like cash received from issue of equity shares and debentures, loan repayment, etc. AS3 defines financing activities as the activities that helps to change the owner's capital and borrowings of the organization. Cash inflows from financing activities. Cash received from issuing shares and debentures. Cash received from issuing loans, bonds and other short or long-term period borrowings. Cash outflows from financing activities. Cash repayment of borrowed amount. Interest paid on debentures and long-term loans. Dividend paid on shares. Treatment of some peculiar items. Extraordinary items. These items are not regular items, but that are non-recurring in nature, like loss due to theft or flood. These items should be handled separately to help user to understand their nature and effect on present and future cash flows. Interest and dividend. In case of organizations whose business is to lend or borrow money, the interest received or paid or dividend received is operating activity, whereas dividend paid is treated as financial activity. Taxes on income and gains. Taxes can be tax on income, on capital profits, or on dividends. AS3 specifies that tax on operating profit should be treated as operating cash flows. Tax paid on dividend should be considered as financing activity. Tax paid on capital gains should be considered as investing activity. Non-cash transactions. As per AS3, the activities that does not include cash or cash equivalent are not be considered in cash flow statement, like redemption of debentures by issuing equity shares. These transactions should be displayed somewhere else in the books of accounts. Ascertaining cash flow from operating activities. Direct method. As per AS3, there are two methods to calculate cash flows from operating activities. 1. Direct method. Under this method, the main items of cash inflows and cash outflows are considered. The items are recorded on accrual basis in profit and loss statement. So few adjustments are done to convert those items into cash basis, like A. Cash receipts from customers equal to revenue from operations plus trade receivables in the beginning minus trade receivables in the end. B. Cash payments to suppliers equal to purchases plus trade payables in the beginning minus trade payables in the end. C. Purchases equal to cost of revenue from operations minus opening inventory plus closing inventory. D. Cash expenses equal to expenses on accrual basis plus prepaid expenses in the beginning and outstanding expenses in the end minus prepaid expenses in the end and outstanding expenses in the beginning. According to AS3, under the direct method, information regarding major categories of gross cash receipts and cash payments may be obtained either from the accounting details of the organization, by making adjustments in revenue from operations, revenue cost from operations, and other items in the profit and loss statement for the followings. 1. Changes in the inventory during that period and trade receivables and payables. 2. Other non-cash items. 3. Other items for which financing cash flows. Ascertaining cash flow from operating activities. Indirect method. Indirect method. Indirect method of calculating cash flow from operating activity starts with net profit and loss because it includes the effects of an operating activity on the organization. The statement of profit is based on accrual, not on cash basis. It also includes many non-operating items like interest paid, profit and loss on sale of fixed assets. As per AS3, in the indirect method, the net cash flow from operating activities is to be calculated by adjusting net profit or loss for the effect of depreciation, goodwill written off, which are to be added back. All investing and financing incomes are to be deducted from net profits, whereas all such expenses are to be added back. Increase in current assets and decrease in current liabilities are to be deducted, while increase in current liabilities and decrease in current assets are to be added up. It provides information that is important to calculate future cash flows. While calculating the cash flow from operating activities, the net profit before taxes and extraordinary items is to be considered, not the net profit calculated as per profit and loss statement. At times, the amount of net profit is not specified, and the statement of profit and loss is also not given. In such a case, the amount of net profit can be calculated by comparing the statement of profit and loss given in the comparative balance sheets for 2 years. The difference is treated as the net profit for the year, and then after deducting the amount of tax made during the year, the amount of net profit before tax can be calculated. Ascertainment of cash flow from financial and investing activities. When we prepare cash flow statement, all main items of gross cash receipts, gross cash payments, and net cash flows must be shown separately under the heading Cash Flow from Investing Activity and Cash Flow from Financing Activity. Preparation of Cash Flow Statement. As we have stated earlier also that the cash flow statement gives information about change in the cash or cash equivalents of an organization in an accounting year. The activities that contribute to these changes in cash or cash equivalents are classified as operating, investing, and financing. Preparation of cash flow statement. The method which we use to calculate net cash flow from all the 3 activities have already been discussed. While preparing cash flow statement, full detail of inflows and outflows are given under the prescribed heads, including the net cash flow. The total of net cash flow is calculated as shown as net increase or decrease in cash or cash equivalents. After this, the amount of cash or cash equivalents in the beginning is added and the amount of cash or cash equivalent at the end of the year is calculated. This amount will be the same as shown as total amount of cash in hand or cash at banks or cash equivalent in the balance sheet. Another point that needs to be considered is that when cash flows are calculated for operating activities through indirect method, then the statement itself is known as indirect method cash flow statement. If the cash flow from operating activities are worked by direct method while preparing the cash flow statement, it will be termed as direct method cash flow statement. Unless it is mentioned clearly as to which method is to be used, the cash flow statement may preferably be prepared by an indirect method, as is done by most companies in practice. Summary. Let us summarize what we have learned in this module. A cash flow statement divides the cash flows into operating, investing, and financial activities. The objective of the cash flow statement is to provide useful information about cash inflows and outflows to the organization under various categories like operative activities, investing activities, and financial activities. A cash flow statement, along with other statements, helps a user to measure the changes in the net assets of the company, its financial structure and ability. The cash means cash in hand and demand deposits with the banks, and cash equivalent mean short-term, highly liquid investments that can be easily converted into cash and which have the risk of changes in the value. An investment is called as cash equivalents only when it has a short maturity, like 3 months or less from the date of acquisition. Cash flow means circulation of cash in and out because of some non-cash items. When we receive cash from a non-cash item, that is known as cash inflow. When we make payment in cash for such items, that is known as cash outflow. As per AS3, the activities in cash flow statements can be divided into 3 categories: operating, investing, and financial activities. Operating activities are those activities that involve the primary activities of an organization. AS3 defines investing activities as acquiring the disposing of long-term assets and other assets that are not included in cash equivalents. Cash from financing activities includes capital or long-term funds of an enterprise, like cash received from issue of equity shares and debentures, loan repayment, etc. Extraordinary items are not regular items, but that are non-recurring in nature, like loss due to theft or flood.
Learning objectives. After studying this module, students will be able to understand the nature and objectives of financial statements of a company, explain the components of profit and loss account, detail the form of balance sheet, understand the importance of financial statements, know the significance of financial statements, understand the limitations of financial statement. Introduction to financial statements of a company. Meaning of financial statement. Financial statements are the annual reports of a company with the help of which a company gives information to its owners, investors, and tax authorities about the financial position of a company. It basically includes balance sheet at the end of the year and profit and loss account. These days, cash flow statement is also considered important while we talk of financial statements. Nature of financial statements. The American Institute of Certified Public Accountants states the nature of financial statements as the statements prepared for the purpose of presenting a periodical review of report on progress by the management and deal with the status of investment in the business and the results achieved during the period under review. They reflect a combination of recorded facts, accounting principles, and personal judgments. Points that explains the nature of financial statements. Recorded facts. These statements are prepared on the basis of facts entered in the books of accounts in the form of data. The amounts of various accounts such as cash in hand, cash at bank, fixed assets, etc. are taken as amount recorded in the accounting books. As these are not based on market prices, the financial statements do not show the current financial condition of the concern. Accounting conventions. Many conventions are followed by making financial statements. The valuation of assets at cost less depreciation principle is followed. The items like pencils, pens are treated as expenditure in the year in which they are purchased, even though they are assets in nature. The use of accounting conventions makes financial statements comparable, simple, and realistic. Nature of financial statements. Postulates. Financial statements are prepared on many assumptions known as postulates, such as going concern postulate, money measurement postulate, realization postulate, etc. Going concern postulate assumes that the organization is treated as a going concern and exists for a longer period of time. Money measurement postulate assumes that the value of money will remain the same in different periods, though there is a drastic change in purchasing power of money. The assets purchased at different times will be shown at the amount paid for them. In profit and loss, the revenue is included in the sales of the year, in which the sale was done even though the sale price may be received over a number of years. The assumption is known as realization postulate. Personal judgments. Personal opinion, judgments, and estimates are made while preparing the financial statements to avoid any possibility of overstatement of assets and liabilities, income and expenditure, keeping in mind the convention of conservatism. The depreciation is provided taking into consideration the useful economic life of fixed assets. Provisions for doubtful debts are made on estimates and personal judgments. In valuing inventory, cost or market value, whichever is less, is being followed. While deciding either cost of inventory or market value of inventory, many personal judgments are to be made based on certain considerations. Objectives of financial statements. Financial statements provide information to the shareholders and other external parties like investors for understanding the profitability and financial position of any business concern. They give information in terms of assets and liabilities, which provide the basis for making decisions. So the main objective of financial statements is to assist the user in the decision making. The specific objectives include to provide information about economic resources and obligations of a business. Financial statements provide time to time and adequate information about the economic resources and obligations of the business to investors and other external parties. To provide information about components of financial statements 1. Generally, there are two types of financial statements that are prepared in the accounting. Those are balance sheet and profit and loss account. These statements are required to be prepared as the report of these statements helps a business to plan, decide, and information can be given to external parties about the financial position of the business. Shareholders' funds. These funds are subclassified in the balance sheet. Share capital. The following modifications or additions are significant. A. For each type of shares, knowledge of the number of shares outstanding at the beginning and at the end of the reporting period is required. B. The rights, preferences and restrictions of each class of shares should be mentioned. C. There should be clarity regarding the identity of ultimate owners of the company by 1. Disclosing share in respect of each class in the company held by its holding company. 2. Disclosing shares of each shareholder holding more than 5% shares, specifying the number of shares held. 3. Disclosure of the following in the balance sheet. Aggregate number of class of shares allotted as fully paid up. Aggregate number of class of shares allotted as fully paid up by way of bonus shares. Aggregate number of class of shares bought back. Components of financial statements Part 2. For each class of share capital. 1. The number and amount of shares authorized. 2. The number of shares fully paid, subscribed, issues and subscribed but not fully paid. 3. Value of per share. 4. Number of shares outstanding at the beginning and end of the accounting year. 5. Rights, preferences and restrictions on each class of shares. 6. An aggregate number of shares with respect to each class in the company held by its holding company. 7. Shares reserved for issues under options and contracts. 8. For a period of 5 years immediately preceding the date at which balance sheet is prepared for. A. Shares reserved under contracts or commitments. B. Number and class of shares bought back. C. Number and class of shares allotted for consideration other than cash and bonus shares. 9. Terms of any securities convertible into equity or preference shares. 10. Calls unpaid. 11. Fortified shares. Reserve and surplus. The reserve and surplus can be classified as capital reserve, capital redemption reserve, securities premium reserve, debenture redemption reserve, revaluation reserve, share options outstanding accounts, other reserves, surplus. Additions and modifications for disclosing of reserve and surplus. A reserve that is represented by earmarked investments shall be termed as fund. Debit balance of profit and loss account should be shown as negative under surplus head. The balance of reserve and surplus after adjusting negative balance of surplus shall be shown under reserve and surplus head even if amount is negative. Share outstanding account has been recognized as a separate item under reserve and surplus. Current and non-current classification and borrowings. Money received against warrants. Money received against share warrant is displayed as a separate item under shareholders' funds. Current and non-current classifications. The balance is divided into current and non-current assets and liabilities. Current, non-current distinction, if it is involved in the organization's operating cycle, is expected to be realized within 12 months. Held for trading, is cash or cash equivalent. If an organization does not have unconditional rights to defer settlement of the liability for at least 12 months after the reporting period. Other assets and liabilities are non-current in nature. Share application money pending allotment. Share application money not more than the issued capital and to the extent non-refundable shall be classified as non-current. It will be shown on the face of the balance sheet as share application money is a pending allotment. Borrowings. Borrowings can be classified as long-term loans, short-term loans, and current maturity to long-term debt. Long-term borrowings. The loans which are repayable for more than 12 months are called to be as long-term borrowings. Short-term borrowings. The loans that are repayable within 12 months are called as short-term borrowings. Current maturity to long-term debts. It includes amount repayable within 12 months or operating cycle under other current liabilities with note to account. Deferred tax assets. Liabilities are always non-current. Trade payables. Trade payables should be settled beyond 12 months from the date of the balance sheet or beyond the operating cycle, are classified under other long-term liabilities. Provisions. The provisions amount of settlement within 12 months from balance sheet date or within operating cycle period from the date of its recognition is classified as short-term provisions and shown under current liabilities on the balance sheet. Current assets and liabilities. Fixed assets. The tangible and intangible assets both are non-current. If the useful life of the asset is less than 12 months, it will still be treated under non-current. Investments. Investments which are to be realized within 12 months are considered as current assets. Others are classified as non-current assets. Inventory. All inventory is treated as current. Trade receivables. Trade receivables which are realized after the 12 months from reporting date or operating cycle starting from the date of their recognition are classified as other non-current assets. Cash and cash equivalent. It is always treated as current. Uses and importance of financial statements. The various uses and importance of financial statement are: report on stewardship function. It helps us to understand the gap between the target set and target achieved. The owner's expectation can be understood by financial statements. Basis for fiscal policies. The financial statement provide inputs for industrial, taxation and other economic policies of the government. Basis for granting credit. Credit authorities take decisions based on the financial performance of the undertakings. Thus, financial statements form the basis for granting of credit. Basis for prospective investors. Financial statements help the investors to calculate long-term and short-term solvency as well as the profitability of the concern. Guide to the value of the investment already made. Financial statements provide information to the shareholders in taking such important decisions for safety and return on investment. Limitations of financial statements. Aids trade association in helping their members. The associations involved in trading can analyze the financial statements for the purpose of providing service and protection to their members. Help stock exchanges. Financial statements is helpful for stock exchanges in understanding how much transparency is there in reporting on financial performance and enables them to call for required information to protect the interest of investors. The financial statements helps the stockbrokers to judge the financial position of business concerns and take decisions. Limitations of financial statements. Do not reflect current situation. As purchasing power of money keeps on changing, the values of assets and liabilities shown in financial statement do not reflect current market situation. Assets may not realize. Accounting based on certain conventions, some assets may not be realized at the stated values if the liquidation is forced on the company. Bias. Financial statements are the result of recorded facts, accounting concepts and conventions used and personal judgments made in different situations by the accountants. Hence, accountants can be biased at times. Aggregate information. Financial statements show aggregate information rather than detailed information. Vital information missing. The information about loss of market or ceasing of agreement is not disclosed by the balance sheet. No qualitative information. These statements show only monetary information, not qualitative information about the company. They are only interim reports. The profit and loss account prepared under financial statement does not reflect the earning capacity of the business over time. Balance sheet also does not reflect the future risks of the company. Summary. Let us summarize what we have learned in this module. Financial statements are the annual reports of a company. It helps business owners, investors, and tax authorities to understand the financial position of a company. Financial statements are prepared on the basis of facts entered in the books of accounts in form of data. Financial statements are prepared on many assumptions known as postulates, such as going concern postulate, money measurement postulate, and realization postulate. Financial statements give information in terms of assets and liabilities, which provide the basis of making financial decisions. Financial statements provide time to time and adequate information about the economic resources and obligations of the business. There are two types of financial statements. They are prepared in the accounting. Those are balance sheet and profit and loss account. A reserve that is represented by earmarked investments shall be termed as fund. Borrowings can be classified as long-term loans, short-term loans, and current maturity to long-term debt. The loans which are repayable for more than 12 months are called to be as long-term borrowings. The loans that are repayable within 12 months are called as short-term borrowings.
Learning objectives. After studying this module, students will be able to understand the nature and significance of the financial analysis, identify the objectives of financial analysis, know the various tools of financial statement analysis, understand the limitations of the financial analysis. Meaning of financial statement analysis. When we do a critical evaluation of the financial statements to understand and make decisions for operations of the organization, is called as financial statement analysis. It is a study of the relationship of various financial facts and figures given in a set of financial statements and interpretation to know the profitability and operational efficiency of the business. The term financial analysis includes analysis and interpretation. Analysis means simplifying financial data by methodical classification that is given in the financial statement. Interpretation means telling the meaning and significance of data. An analysis is useless without interpretation, and interpretation is impossible without analysis. Significance of analysis of financial statement. The purpose of the financial statement is to identify the strengths and weakness of an organization. Analysis of balance sheet and profit and loss account statements. This analysis can be done by the company itself or by the outside parties like owners, investors, lenders, traders, etc. The financial analysis is useful for many users. Let us discuss that briefly. Meaning of financial statement analysis. Finance manager. Financial analysis tells us about the facts and relationships related to managerial performance, strengths of the company financially, and creditworthiness of the company. These analysis tools help a finance manager to make decisions and testing the efficiency of the operations. Top management. With the help of financial analysis, the top management came to know the resources of the firm and whether those resources are fully utilized or not. It helps in measuring the success of the operations, sound financial position of a firm, and the and evaluating the internal system control. Trade payables. With the help of analysis, the trade payables know the ability of the company to pay its obligation and came to know the profitability of the company. Trade payables are interested in the company's ability to pay their dues. Lenders. Suppliers who give long-term debts to the company are interested in their long-term solvency. They analyze the profitability of the company with these statements: the firm's ability to generate cash, to pay long-term debts, profitability, etc. Investors. The investors who have invested money in firms' shares are interested in knowing the earnings of the firm. They also evaluate the efficiency of the management. Their decision to buy more shares, sell shares depends upon the analysis. Labor unions. Labor unions need the analysis of financial statements to find out whether the company can presently afford a wage increase and whether it can absorb a wage increase through increased productivity or by raising the prices. Others. The economists, researchers, etc. analyze the financial statements to study business and economic conditions. The government agencies need it for price regulations, taxation, and other similar purposes. Objectives of analysis of financial statement. The analysis of financial statements tells the important information related to managerial performance and the efficiency of the firm. In other words, the objectives of the analysis are to use the information contained in financial statements to know the weakness and strengths of the firm and to predict about the future prospects of the firm so that decisions regarding the operation of and further investment in the firm can be taken. Basically, it serves the following purposes: helps to assess the profitability of the business and operational efficiency of the business, to find out the importance of different components on the financial position of the business, to find out the reasons for change in the financial position of the business, to judge the ability of the firm to repay its debts. Tools for analysis of the financial statements. Comparative statement. These statements show the profitability and financial position of the business for different periods to make a comparative analysis. It is usually done on profit and loss account and balance sheet. Comparative analysis indicates the trend and direction of financial position and operating results. This analysis is also known as horizontal analysis. Common size statements. These statements express the relationships of different items of a financial statement with a common item, expressing each item as a percentage of that common item. These statements allow an analyst to compare the operating and financial characteristics of two companies of different sizes of the same industry. Common size statements are useful both in intra-firm comparisons over different years and for making inter-firm comparisons for the same year or for several years. This analysis is also known as vertical analysis. Tools for analysis of the financial statements. Trend analysis. It is a technique of studying operational results and financial position over a series of years on the basis of previous year's data of a business enterprise. The trend analysis can be done to observe the percentage changes over the time in the selected data. It is important because by looking at the trends over a period, one may find whether the trend is rising, falling, or stable. Ratio analysis. It explains the relationship that exists between various items of a balance sheet and a statement of profit and loss of a firm. Accounting ratios measure the comparative significance of the individual items of the income and position statements. Cash flow statement. It tells about the movement of cash in and out of the business. When cash comes in the business, that is called as cash inflow. Whereas when cash goes out of business, that is called as cash outflow. The difference between the both is net cash flow. Cash flow statement projects the way in which the cash has been received and has been utilized during an accounting year, as it shows the sources of cash receipts and also the purposes for which payments are made. Comparative statement. These statements include the statement of profit and loss and the balance sheet for both the current year as well as for the previous year, and for the changes during the year, both in absolute and relative terms. So, it is possible to find out not only the balances of accounts as on different dates, but also the extent of their increase or decrease between these dates. The comparative statements can be used for finding the direction of changes and trends of performance of an organization as well. Steps to prepare comparative statement. Step 1. List out absolute figures in rupees relating to 2 points of time. Step 2. Find out the change in absolute figures by subtracting the first year, column 2, from the second year, column 3, and indicate the changes as increase, plus, or decrease, minus, and put it in column 4. Step 3. Preferably, also calculate the percentage change as follows and put it in column 5. Common size statement. Common size statement, which is also known as component percentage statement, is a tool for studying the changes and trends in the financial position and operational result of the company. In this statement, each item is stated as a percentage of the total, of which that item is a part. Common size analysis is mainly used for comparing enterprises which differ in size, as it provides an insight into the structure of financial statement. Limitations of financial statements. Steps to prepare common size statement. Step 1. List out absolute figures in rupees at 2 points of time, say year 1 and year 2. Step 2. Choose a common base as 100. For example, revenue from operations may be taken as a base 100 in case of statement of profit and loss, and total assets or total liabilities 100 in case of balance sheet. Step 3. For all items of column 2 and 3, work out the percentage of that total, column 4 and 5. Limitations of financial statements. Though the financial statement is helpful in depicting the financial position of a business and tells the financial strengths and weakness of the organization, the financial analysis also has various limitations of financial statements. Hence, the analyst must be careful of the impact of price level changes, window dressing of financial statements, changes in accounting policies of a firm, accounting concepts and conventions, personal judgment, etc. Financial analysis does not take care of price level changes. Financial analysis may mislead if the accounting procedure of the company is not clear. Financial analysis is just a study of the reports of the company. It only considers monetary information alone, while non-monetary aspects are ignored. The financial statements are prepared on the basis of accounting concept. As such, it does not reflect the current position. Summary. Let us summarize what we have learned in this module. Financial analysis includes analysis and interpretation. Analysis means simplifying financial data by methodical classification that is given in the financial statement. Interpretation means telling the meaning and significance of data. The purpose of the financial statement is to identify the strengths and weakness of an organizational analysis of balance sheet and profit and loss account statements. Financial analysis tells us about the facts and relationships related to the managerial performance, strengths of the company financially, and creditworthiness of the company. With the help of financial analysis, the top management came to know the resources of the firms and whether those resources are fully utilized or not. The analysis of financial statements tell the important information related to managerial performance and the efficiency of the firm. Financial analysis helps to assess the profitability of the business and operational efficiency of the business. There are
Learning objectives. After studying this module, students will be able to know the meaning of not-for-profit organization, explain the features of not-for-profit organization, understand the types of account prepared by not-for-profit organization, understand the financial statements prepared by not-for-profit organization, know the difference between income and expenditure and receipt and payment account, learn the treatment of certain peculiar items in final accounts. What is not-for-profit organization? What are not-for-profit organizations? The organizations that work for the welfare of the society and for a non-profit motive are known as not-for-profit organizations. Generally, charitable organizations come under this category. The purpose of these organizations is to serve to a public group. These organizations generally do not manufacture goods or sell or purchase goods. The source of their income is generally donations, subscriptions from their members, grants from the government, or income from investment. These organizations maintain accounts to exercise a control over utilization of funds. Features of a not-for-profit organization. The main features of such organizations are: these organizations are formed for giving services to groups at large, like education, healthcare, and sports. These organizations run for non-profit or charge a nominal cost. These organizations usually work as a charitable trust or societies. Their functions usually managed by a committee elected by its members. The sources of income of such organizations are through subscriptions from members, donations, grants by the government, or income from investments. The income through various sources is credited to capital fund or general fund. These organizations work for the welfare of the society or for social cause. The accounting information these organizations provide is meant to meet the statutory requirement of present and potential contributors. Accounting records for not-for-profit organization. As we know that the main source of income for these organizations is through subscriptions, donations from the government, or financial institutions. These organizations do transactions in the cash or through banks. They need to maintain a proper record of their transactions. That is why they keep a cash book for recording day-to-day transactions. These organizations also maintain a ledger that contains a record of all incomes, expenses, assets, and liabilities, which helps in the preparation of financial statements at the end of the accounting year. They maintain a capital fund to record the subscriptions, donations, etc. Final accounts of financial statements. At the end of the financial year, the not-for-profit organizations are also need to prepare financial statements. But to know whether the income earned by these organizations is enough to meet the expenditures, these organizations are also required to give this information to the members, donors, investors, and registrar of societies. Thus, the final accounts of a not-for-profit organization consists of receipt and payment account, income and expenditures account, and balance sheet. If an organization is recording the transactions through the double entry system, then they must prepare a trial balance for checking the accuracy of the ledger accounts. Receipt and payment account. This account is prepared at the end of the accounting year on the basis of cash received and cash payments that are recorded in the cash book. It is a record of cash and bank transactions under various heads. For example, the money received from members as subscriptions will appear on the debit side of the cash book and will be shown as a receipt in the receipt and payment account. Receipt and payment account records various receipts and payments, whether they belong to the current period, previous year, or the coming year, or whether they are of capital or revenue nature. It does not show any depreciation. The opening balance in receipt and payment account shows cash in hand or cash at bank, which is shown on its receipt side, and the closing balance represents cash in hand and bank balance as at the end of the year, which appear on the credit side of the receipt and payment account. A detailed list of items of receipt and payment account is given as follows. Salient features of receipt and payment account. Let us discuss these features one by one. It is like a cash book in which receipts are recorded on the debit side while payments are entered on the credit side. It records the amounts of all receipts and payments, whether it belongs to the current year or not. It records all types of receipts, whether they are of capital nature or revenue nature. There is no difference between the cash or bank transactions. This account does not show items like depreciation, outstanding expenses, accrued income, etc. This account starts with an opening balance of cash in hand or bank and closes with the balance of cash in hand or bank overdraft at the end of the year. Steps to create receipt and payment account. We need to enter the items as follows. Enter the opening balances of cash in hand or cash at bank on the debit side and bank overdraft on the credit side of account. Show the amount of all receipts on its debit side, irrespective of the year to which they belong. Show the amount of payments on the credit side, irrespective of the year to which they belong. No receivable income and payable expenses are to be accounted in the books of accounts. Difference between the payment and receipts is to be entered as cash in hand, as closing balance, or bank overdraft in the debit. Income and expenditure account. It is like a profit and loss account that is prepared on the accrual basis in any business. It records only revenue items, and the balance at the end of the accounting year is represented as surplus or deficit. The expenses and losses are represented on the expenditure side, whereas all the incomes or profits are represented on the income side. It shows the net profit or net loss at the end of the accounting year. Steps in preparing income and expenditure account. We need to take the following steps while preparing income and expenditure account from receipt and payment account. Study the receipt and payment account in details. Exclude the opening and closing balances of cash and bank from income and expenditure account. Don't include capital receipts and capital payments, as these things will be reflected in the balance sheet. We should consider only the revenue receipts to be shown on the income side of the income and expenditure account. Enter the revenue expenditures to the expenditures side of the income and expenditure account. The depreciation, profit and loss of sale of fixed assets, and doubtful debts also considered in income and expenditure account. Let us take an example. From the receipt and payment account given below, prepare the income and expenditure account of Clean Delhi Club for the year ended March 31st, 2007. Difference between receipts and payment account and income and expenditure account. Difference between receipt and payment versus income and expenditures account. We can differentiate between the both on the basis of the following factors. Nature. Income and expenditure account is like a profit and loss account, whereas receipt and payment account is like a cash book. Nature of items. Income and expenditure records only capital nature expenditures and income, whereas receipt and payment account considers both revenue and capital nature transactions. Period. Income and expenditure account considers only current year's transactions, whereas receipt and payment account considers income and expenditures of previous and succeeding years also. Debit side. Debit side of the income and expenditure account takes expenses and losses, whereas debit side of the receipt and payment account enters receipts. Credit side. Credit side of the income and expenditures account enter incomes and profits, whereas the credit side of receipt and payment account considers payments. Depreciation. Income and expenditure account records depreciation, whereas receipt and payment account does not include depreciation. Opening balance. Income and expenditure account does not have any opening balance, whereas receipt and payment account takes to cash in hand or bank overdraft. Closing balance. Closing balance in income and expenditure account shows an excess of income over expenditures or vice versa, whereas receipt and payment account represents cash in hand or bank overdraft. Balance sheet and its preparation. Balance sheet. Balance sheet is prepared by a non-profit organization to know the financial position of the organization. It displays assets and liabilities at the end of every financial year. Assets are displayed on the right side, whereas liabilities are displayed on the left side. The difference is that it has a capital fund in place of capital and surplus or deficit as per income and expenditures account is to be added or deducted from the capital fund. We add some items like legacies, life membership fees, and entrance fees directly in the capital fund. There can be other funds too, like sports fund, building fund, donors fund, etc., to cater specific purposes. Steps to prepare balance sheet. Take the capital fund as per opening balance and add surplus from the income and expenditure account. Add entrance fees, legacies received during the year. Consider all the fixed assets with additions after charging depreciation. Compare items on the receipts side of the receipts and payments account with income side of the income and expenditure account. Compare items on the payment side of the receipts and payments account with expenditure side of the income and expenditure account. Peculiar items in non-profit organizations. We prepare the final accounts of the non-profit organization with the same format as we prepare for other business organizations. There are few items which are different in nature and need to be taken care while preparing final accounts of these organizations. Let us discuss these items one by one. Subscriptions. Subscriptions are basically the membership fee paid by the member of the organization on annual basis. This subscription is the main source of income for non-profit organizations. Subscription, which is paid by the members, is considered as a receipt in the receipt and payment account and as income in the income and expenditure account. It is important to note that subscription received by the organization is shown as total amount received as a subscription in the receipt and payment account, irrespective of the year in which it is received, whereas income and expenditure account shows only current year's subscription, where it is received or not. For example, a club received Rs 20,000 as subscriptions during the year 2005-6, of which Rs 3,000 rebate to year 2004 and 5, and Rs 2,000 to 2006 and 7. At the end of the year 2005-6, Rs 6,000 are still receivable. In this case, the receipt and payment account will show Rs 20,000 as receipt from subscriptions, but the income and expenditure account will show Rs 21,000 as income from subscriptions for the year 2005 and 6, the calculation of which is shown in the referenced image. Donations. Donations are a kind of gift an organization receives in cash or property received as a gift from some person or organization. It is displayed on the receipt side of the receipt and payment account. Donations can be general or given for some specific purposes. Specific donations. If the donation is to be utilized for a specific purpose, then it is called specific donation. These specific purposes could be an extension of the existing building, construction of new computer laboratory, creation of a book bank, etc. Such donation is to be shown on the liabilities side of the balance sheet, whether the amount is big or small. General donations. Such donations are utilized for the general purpose of the organization. These are treated as revenue receipts, as general donations are the regular source of income for such organizations. It is taken to the income side of the income and expenditure account of the current year. Legacies. Legacy, as the name suggests, is the amount received as per the will of a deceased person. If the amount is big, then it appears on the receipt side of the receipt and payment account and is directly added to the capital fund in the balance sheet, because it doesn't occur again and again. If the amount is small, then it is treated as income and shown on the income side of the income and expenditure account. Life membership fees and other items. Life membership fees. The amount paid by the members as a lump sum rather than periodic as membership fee is treated as capital receipt and credited to capital fund directly. Entrance fees. Entrance fee, which is also called as admission fee, is paid only once by the member at the time of taking membership. In case of organizations that are limited in numbers, like clubs, and the amount of entrance fees is high, it is treated as non-recurring item and credited directly to capital or general fund. In case of some organizations, like educational institutions, the admission fees are a regular income and the amount involved may also be small. Then we treat this item as a revenue receipt. If there is specific instruction, the entire amount is treated as capital receipt and should be directly added to capital or general fund. Sale of old assets. The money received by the sale of old assets is to be included in the receipt and payment account of the year in which it's sold, and any profit or loss is to be displayed in income and expenditure account. Sale of periodicals. It is an item that reoccurs and hence it is treated as income and shown in the income side of income and expenditure account. Other items. Sale of sports materials. The sale of sports old material like balls, bats, net is sold by the clubs. It is shown as income in the income and expenditure account. Payment of honorarium. The amount that is paid to the person who is not a regular employee of the organization is called honorarium. For example, payment made to an artist for giving a performance at the club is an example of honorarium. It is shown on the expenditure side of the income and expenditure account. Endowment fund. It is the amount received from a gift, the income of which is meant for a specific purpose. Therefore, it is considered as a capital receipt and reflected on the liabilities side of the balance sheet. Government grant. Many educational institutions, universities, colleges depend upon the grant of the government for their activities. The grants that are recurring in nature is treated as revenue receipt and credited to income and expenditure account, whereas grants like building grant is treated as capital receipt and is transferred to the building fund. The cash subsidy can be taken as revenue income for the year in which it is received. Special funds. The non-profit organizations create special funds for special purposes like sports fund, match fund, prize fund, etc. Such funds are treated as investment in securities, and the income earned on such investments is added to related funds and not in the credit of income and expenditure account. And the same way the expenses are also deducted from the related fund. Stationery. Normally expenses incurred on stationery or any time that is consumable are charged to income and expenditure account. But in case of stock of stationery opening and or closing is given, the approach would make necessary adjustments in purchases of stationery and work out the cost of stationery consumed and show that amount in income and expenditure account and its stock in the balance sheet. Income and expenditure account based on trial balance. As we have learnt that in the case of a non-profit organization, the income and expenditure account and balance sheet are prepared on the basis of receipt and payment account. But sometimes the trial balance is also considered along with additional information. For example, from the trial balance and other information given below for a school, prepare income and expenditure account for the year ended on 31st March 2006 and a balance sheet as on that day. Incidental trading activity. At times, chemist shop, hospital, canteen, beauty parlor, etc. facilities is provided to the members or public as a part of trading activity. In such cases, the trading account has to be prepared to find out the results of such incidental activity. The profit from such trade activities is used to fulfill the main objectives of the organization, and so it is transferred to the income and expenditure account. The following procedure is followed to create such an account. Prepare trading account to calculate profit or loss due to such commercial trading. All costs and revenues directly and exclusively related to such trading activity are recorded in the trading account, and the balance of trading account is transferred to income and expenditure account. In addition to trading profit or loss, all other incomes and expenses not recorded in the trading account, surplus or deficit revealed by the income and expenditure account is transferred to capital or journal fund. For example, Shiv E. Narayan Education Trust provides the information in regard to receipt and payment account and income and expenditure account for the year ended March 31st, 2017. On March 31st, 2016, the following balances appeared. Investments rupees 1,60,000, furniture rupees 40,000 and books rupees 20,000. Prepare opening and closing balance sheet. Balance sheet as on 31st March 2016. Balance sheet as on 31st March 2017. Summary. Let us summarize what we have learned in this module. The organizations that work for the welfare of the society and for a non-profit motive are known as not-for-profit organization. The main source of income for these organizations is through subscriptions, donations from the government or financial institutions. Receipt and payment account is prepared at the end of the accounting year on the basis of cash received and cash payments that are recorded in the cash book. Receipt and payment account records the amounts of all receipts and payments, whether it belongs to the current year or not. Income and expenditure account records only revenue items, and the balance at the end of the accounting year is represented as surplus or deficit. Balance sheet is prepared by a non-profit organization to know the financial position of the organization. Donations are a kind of a gift received in the form of cash or property from some person or organization. Legacy, as name suggests, is the amount received as per the will of a deceased person. The